This is the New York Fire Department Pension Fund Investment Meeting. Today is 4/20/2011. It's 9:45. We're at the Controller's Office, 1 Center Street, room 530, New York, New York. We have the roll call, trustees.
Roll call of trustees. Ms. Ranju Nagaswamy. Here. Mr. Larry Schloss.
Here.
Ms. Janice Emery. Here. Mr. Cassidy.
Mr. Slevin is Mr. Cassidy's proxy.
Mr. James Slevin.
Here.
Mr. Robert Straub.
Present.
Mr. John Kelly.
Mr. Straub has Mr. Kelly's proxy.
Mr. James McGowan.
Here.
Mr. John Dunn.
Here.
Mr. James Amanda.
He's en route.
Mr. O'Connor, Sean O'Connor. Commissioner Douglas White.
Present.
We have 22.5 votes, and a quorum. We can start a meeting.
We'll start with the public agenda.
Okay. Martin, you want to hand out the color slides? Mark's handing it out. If you just look at the agenda, it's going to be a pretty straightforward meeting. We've got Deutsche Bank coming in to talk about the economy. It's not going to be pretty quick going through the economy. Then we have GMO and asset allocation. Mark's going to talk about fixed income, and then we'll go through.
She could not hear you.
All right. Yeah. I said it's going to be a pretty straightforward agenda. We have Deutsche Bank talking about the economy, so I'm going to be pretty brief on my economic slide. GMO for asset allocation. Martin talking about opportunistic fixed income.
Oh, excuse me a second, hold a second. Obviously it's hard, so maybe we should move around while Larry's talking, just so the reporter can hear.
Nobody move.
Okay. Nobody-
Anyway, everybody have their presentations? All right. So let's go through this pretty quickly. So the first page is the GDP. People are starting now to worry. It's growing at about 3.5%. People are starting to worry it's going to slow down. Something between 3 and 3.2%, which is going to have all sorts of repercussions for us in the markets. Page 3, see capacity utilization going up, but it leveled off a little bit toward the end of the first quarter. Manufacturing on page 4 is going up, but again, a little leveling off at the end of the first quarter. Page 5, unemployment claims are trending nicely down. Still too high, but the trend is clear. Unemployment is at 8.8%, still unacceptably high, but also coming off the peak. You can see on the next page consumer sentiment. You can see it dipped a lot in March. March is a reflection of the tsunami and the political turmoil in North Africa and the Middle East. Architectural billings, which is a precursor of building, is going up nicely. Existing home sales not going very far. Big overhang, jobs problem, unemployment. Most importantly, if you look on page 10, you can see new housing construction, new housing starts are also going nowhere because of the overhang caused by foreclosures. Retail sales are about 3%. Not robust, but good enough. Auto sales are trending up, but part of that is because the auto companies are now offering 0% financing. But again, everything is off a very low base, and up is more of the right picture, particularly if you look on page 13, which is the leading economic indicators. Nice trend. CPI, consumer prices are going up, led by energy and food, although the Fed continues not to be very worried about it. They say core inflation is still less than 2%. That's the fight that's going on in the bond market. If you go to page 16, we get to the markets. The monetary authorities in Europe raised rates last week. Hence, the euro's been going up, the dollar's been going down as a result. You can see more acutely on the next page, page 17, the decline of the dollar as we keep our rates down and people start raising them. That's not good for the dollar. On the other hand, The low dollar helps U.S. exports. And again, the S&P put the U.S. on negative watch yesterday or the day before. That'll probably have a declining effect on the dollar as well. 3-month LIBOR is pretty flat, which is good. The VIX is there's not a lot of volatility in the markets despite all of the bad news that's around. People are a little concerned about that. But again, the Fed has pushed everybody to take more and more risk, and there's not an accompanying amount of volatility that goes along with that. It's pretty surprising overall. If you look on page 20, the white line is today's yield curve. Again, it's pretty much within this band. The good news of the yield curve, which you can't really tell here, is the long end is below 5. 30-year fixed rate mortgage is again below 5. That's a good thing. But you can see on page 21, the 10-year treasury bouncing around. If I extend this a little further, it's now again below 340, which is probably too low for it, so I expect to see it come up a little bit in the future. 22, you can see risk premiums continue to collapse. The high yield bonds are, again, people are searching for yield. I think, as we said before, I think they're too low. We've lightened up our high yield bonds as a result and took some good profits and put them into the stock market. 23, you can see the PEs of the 3 major indices, the Russell 3000, EFA, and emerging markets. The bottom line is stocks are not that expensive relative to historical peaks. 24 I'll skip over. It's really just more forward PEs of mid, small, and large cap. 25 you see the stock markets. Again, you can see a nice rebound in the red line, which is emerging markets. Again, the dip is with the tsunami. Markets have come back down and they're right back up again. 26 is M&A activity. Corporations have a lot of cash. An increase in M&A activity means that CEOs feel confident about the economy. So it's a good thing. It's a good leading indicator for stocks as well. That gets the fire. If you look on page 27, you can see that at the end of February, it's about $7.8 billion in the fire fund. It's the all-time high. At the end of March, which isn't on here, it's still about the same number. So despite some volatility in March, you can tell from the prior chart that market's going back up. We're still about $7.7, $7.8 billion, hopefully heading higher. Here you can see it for the last 12 months on page 28. Again, all-time high, doing very, very well. 29 is our asset allocation slide. We're pretty happy with the way that the assets are allocated right about now within the bands. We're a little over-allocated in emerging markets, but as we're going to talk next month about a long-range asset allocation, if we move up to longer-term asset allocation of emerging markets, it doesn't make any sense to try to get within this band if we're about to change the bands in the next month or two. We're underweighted in opportunistic fixed income, which I think is chartreuse on the right-hand side, and Martin's going to talk about that going forward. We did take some money off the table in March, which is not in these February numbers. We sold about 2% of our equity holdings and put it into cash because we were a little worried and took some risk and some profits off the table. That gets us to page 31. I skipped 30, so go to 31. If you look on 31, you can see where we made our money. The month of February, we did very well. We're up almost 2.5% in the month. It was predominantly the equities market. More importantly, fiscal year to date, we're up more than 20%. And again, we've pretty much held that through March, so we got 3 more months to get through the end of the fiscal year. And if you look at the bar chart on the right, on a 3-year basis, we've clearly made up for all the money that was lost in 2008, and we're back in positive territory. Page 32 shows you where the markets were in the month of February. Again, we made a lot of money in the equities. All the equity markets were up. High yield was up. This is about as good as it gets in February again. March was bumpy, but it was bumpy in the middle, but it ended up all right by the time you were done with the rest of March. The rest of the report are the individual managers. I talked to Seaman, Martin, and there really isn't very much to report on this report. Next month we'll probably have a quarterly report, so I'll spend a little more time with the managers. But basically the managers are doing what the manager's supposed to do. It's a little bit over, a little bit under, but for the month, everything was okay. So we'll dispense with going through any individual managers. So with that, does anyone have any questions on February? February's a great month. And we held the greatness in March, but didn't make a lot of money in March, but didn't lose a lot of money in March. Any questions? All good.
No
Perfect.
questions?
Okay. So Martin, you want to bring in Deutsche Bank? So as you know, once a quarter we bring in an outside economist from one of our managers. This quarter it's the guys from Deutsche Bank.
I'd like to note for the record that James Lamonda is now present in the meeting. Would you state your names and affiliations and we'll start, just for the record.
Good morning. My name is Lucille Douglas. I'm with Deutsche Bank, and I would like to introduce my colleague, Torsten Slock. Torsten Slock is our Chief International Economist at Deutsche Bank, and my colleague, Aaron Doyle. We're very delighted to be here this morning, and thank you for the invitation. The purpose of our meeting today, the topic would be that Torsten is going to speak about the implications of the geopolitical risks for the U.S. recovery in the financial markets. In particular, we'll speak about some recent events that have occurred in the last couple of weeks. So what I'd like to do is to turn the discussion over to Torsten.
Thank you. Thank you very much for having us. Obviously, geopolitical risks have become even more important given what Standard & Poor's did to the U.S. rating outlook here earlier this week. I'll talk about that in a minute. But the most important thing is, what do these geopolitical risks mean for the recovery and for financial markets? And we will focus here on 3 different risks on page 1. The first risk we'll look at is the earthquake and nuclear crisis in Japan. Then we'll turn to the Eurozone sovereign crisis, which is developing almost day by day here. And then finally, we'll look at the impact on the US economy and financial markets. Turning then to page 2, what are the events and what are the impacts? What is the bottom line of this presentation? The first event is the Middle East. And the main reason why the events in the Middle East matter is, in our view, mainly because it has implications for oil prices. The second event is the earthquake and the nuclear crisis in Japan. And this is, in our view, not something that has as significant consequences for the US outlook or for US financial markets as oil prices going up. The third and final event that we'll talk about is the Eurozone sovereign crisis. This is also an important event, in particular, of course, for Europe on its own. But what's most important here is that there is still a very small probability that the EMU could break up, and therefore that the global banking system could be very negatively affected, because there's a debt crisis, and the big question is who are the holders of this debt, and if this contagion starts to spread, the implications could be much more serious. But we don't expect that to happen, so the bottom line of the geopolitical risks is that oil prices is really the thing that has the most significant impact on the US outlook, and most importantly on the US consumer. Turning to page 3, one thing, of course, when you think about the US outlook, is to think about what are the expectations, what do we think that will happen in 2011 and 2012. So what you see here is the Bloomberg survey median US GDP growth forecast for 2011 and 2012. And as you can see, since October, expectations, if you take for 2011, the dark blue bar has been moving up, but more recently it has been moving down a bit. So that's of course a very important question here. Why have expectations to the US economy in 2011 and 2012 been moving down? If this is because of oil prices, then since March oil prices have continued to go up. So there's indeed a risk that we could see a continuation of this trend downwards. So the very important starting point is again to think about these risks in terms of what does it mean for the US outlook. And as you can see on this page, it already has had some implications on the outlook being downgraded. Turning then to the geopolitical risk on page 5. One thing to think about when you hear that oil prices are $105 or $120 a barrel is to think about, well, where should oil prices be? And one argument which is very important is that if the economy is doing well, of course oil prices will also start to go up. So given that oil prices have been going up because of demand or the economy doing better, then it's no surprise that oil prices are at very high levels. What's very unique at the moment is that oil prices are probably above where they should be. Specifically what we did here was we tried to quantify in a simple framework oil prices, if you say that they should be going up with global GDP growth and with the dollar, then the light blue line here tells you that oil prices really should be at $90 a barrel. They are not at $90, they are closer to 105 or so in the WTI. So there is, as I've written in the title here, there is a supply premium, or you could say a Libya or a Gaddafi premium, which is $15, saying that oil prices are actually $15 too high compared to where they should have been. And that's important because that means that we could see a reversal if the Middle Eastern tensions start to calm down. Or on the other hand, if they get worse, of course the supply premium could continue to go up. But it's important to know what the benchmark is, and in our view the benchmark is that we're simply now at a level where $15 is what comes in simply because of this geopolitical risk that comes out of the Middle East. The next thing that's important, of course, is to think about what do high oil prices do to the US economy. Every single dollar increase in oil prices definitely has a negative impact on the economy, but the question is, are there any signs of that yet? And one very important place to look at this is on page 6, because what you see here is car sales. Car sales is almost 40% of discretionary consumer spending, so car sales is a very important first place to see evidence of oil prices starting to have a negative impact on the US economy. And what you can see here is that from 1999 to 2007, car sales were running at a rate of around 16 to 17 million, and oil prices really didn't do much to car sales at all. Then, as oil prices started to go up in 2008, you saw car sales come down, and you saw also the financial system, of course, the lack of financing for buying a car was also an important reason why car sales came down so much. In other words, if we in the fourth quarter of 2008 had gone out to a car dealer and said, we'd like to buy a car, the dealer would have said, do you have cash? And if we said, no, I don't have any cash, well, he would say, well, I cannot give you a loan because the financial system is not working properly. And this was a very important reason why we had this crash in car sales, that simply financing was not available. So a very important reason why we have seen this snapback or this rebound in car sales is that the financial system has been coming back. In other words, today, now you can get financing again. So it's very important that this moved back into the range between the scrappage rate, meaning the rate at which we throw out cars, which is 12.5 million, and the per capita break even at 15 million. Now we are getting back to a more normal situation. This was a very unusual situation with such a low level, simply because financing was not available. But in this context, what's relevant now is that now we're back to the normal level. it is very important to look at this series every month and see is there any evidence that high oil prices are indeed starting to push consumers back and say, well, now consumers are buying not as many cars as they did last month. Another way to quantify this on page 7 is when you look at the Federal Reserve has a very simple model of the US economy with literally 200 equations where you can ask the question, if you raise oil prices $10, what does it do to the US economy? And what you can see here in the upper left-hand corner, oil prices at around $110 give you a GDP growth impact of 0.35. So remember, GDP growth normally should be around 2.5. So if I subtract from 2.5, 0.35, then you get something which is manageable, something which is not a dramatic impact on the outlook. But the problem is, if you look at the third column, if oil prices go up to $150 a barrel, then the impact is going to be much more substantial, 1.75. And again, if 2.5 is the benchmark, if I subtract 1.75, suddenly you're getting much closer to 0. So that's why if oil prices go up to these levels, at the moment, as you know, Brent is $125 a barrel. If they continue to go up, then we will have a much bigger problem. So one thing that I think is very important at the moment is that oil prices you can watch on your Bloomberg screen every day and see they go up, but you can only see the reaction from consumers later, meaning only months later. So that's why, in my view, there's a little bit of complacency in financial markets, both in equities and in rates at the moment, that people are saying, oh, oil price is going up. It hasn't really shown up yet. But the risk here is that we should be watching, and I'm worried that it may actually start to show up, given this is the Fed's. I didn't put this together, this is just the Fed's own numbers of quantifying the impacts of oil prices going up. It will eventually have a very significant impact on the outlook. And therefore, again, most importantly, both on equities and also on long-term interest rates. The second risk is the Japanese situation. The easiest way to think about Japan is to think about how big is the Japanese economy in the world economy. And as you can see here, Japan's share in the world's nominal GDP is only about 9%. So Japan is not as significant as others. It is still the third largest economy in the world. But when you look at the next page and ask the question, how big were the areas that were affected by the tsunami and the earthquake and now the nuclear situation? And the answer to that is what you see in the top line, 3 severely damaged prefectures. They are about 3.8% of Japanese consumption, 4.5% of government consumption. So in a nutshell, if these areas that are affected are about less than 5%, and if Japan is about 9% of world GDP, that means that from a world perspective, this is not something that will have a significant impact on world GDP growth. Of course, it has a significant impact on the supply chain, and there's certainly certain industries, most importantly the auto industry, but also the electronics industry more generally, that has been negatively affected. Some estimates suggest that car sales globally could fall up to 25% as a result of the problems in Japan, but this would only be a temporary effect. So the story that I heard recently was that you should imagine that it's not that they cannot produce cars and the dealers will not have cars, it's more that when you go to the dealership, they will only have the car that you want in pink, and you cannot get the car that you want in the right color because they simply don't have the components, and therefore there may be a move down, in particular in June and July, and then we will start to see a move up again. So certain industries are certainly affected, but at the global level, we don't expect that to have any significant consequences on the US overall. Another way on page 11 to try to look at this is to try and get some guidance from what happened at the Kobe earthquake in January 1995. Here you see in January 95, you saw industrial production, which are the bars. Basically think of this as the economic activity. It didn't really move that much. It's actually a little bit difficult to see any movement in terms of what companies were doing. And if you look at what the stock market did, that definitely went down, but it really did rebound only after 6 months and started coming back. So a very important point on the next page is to ask, well, what could then the consequences be, not only of the impact itself, but also of the rebuilding. And as you can see here, if you look at 95 and 96, the rebuilding could have a quite significant impact on the economy. Look at rebuilding on GDP growth, 1.6 and 2.7, and real capex, meaning companies' investment in equipment and software and buildings, 4.4 and 3.6. So overall, there is certainly something here that we should expect to see the Japanese economy get some boost, and that's certainly also something that will help the US, but that's something that's a very slow-moving process. As you can see here, it took 2 years before that started coming along. Third and finally, the Euro debt crisis. One way on page 14 to look at this is to try and ask the question, how bad is it in Europe compared to at the muni or state level in the US. So what we plotted here is debt to GDP in some countries to the left, and debt to GSP, gross state product, in New York, California, and Illinois. And you can immediately, it springs out of this page on its own. It's very clear that the problems at the state level in the US are fairly small compared to how serious the problems are at the national level in Europe. And the most important reason for this really is that, remember, in Europe, the fiscal rules were such that you were allowed to have a budget deficit for almost as long as you wanted. And then suddenly financial markets said, now we no longer want to finance your debt. Whereas at the state level, as you know too well, we have the issue that you must have balanced budgets. There's much more stringent criteria, fiscal rules, which is holding back basically that you cannot run up the same amount of deficits and the same debt levels that you have seen at the national level in the euro area. One thing that's important in the euro area is, of course, that the crisis doesn't spread, and this is what we'll see on page 15. So far, it started out with Greece, then it was Ireland, and now more recently it was Portugal. It's very unusual that Portugal has asked for an IMF program because it doesn't have a government at the moment. But nevertheless, their problem was that they had some funding issues and they simply had no other choice. But the problem for the Europeans is that they would like it to stay so that it is only these three countries that have basically an isolated set of problems that you can deal with. One thing that's important and has got a lot of attention is, of course, Spain, which is the red line here. This chart shows you sovereign CDS spread, so this is the price of insuring you against the default in these different countries. And as you can see, Portugal and Spain have been differentiating themselves from each other. In other words, financial markets have been saying there's much more risk associated with Portugal than there is with Spain. So policymakers in Europe must be very pleased when they look at this and conclude that it looks like there is very little contagion. It seems to be definitely something that is mainly Portugal, Ireland, and Greece. And we don't believe that Spain will get into trouble, so we believe it's justified that this situation looks like it does. One thing, of course, on page 16 that's critical is to think about, well, if you have a deficit, you have a funding need, and if you have a funding need, you need someone to buy your bonds. And that's why this chart shows you how many bonds do the peripheral countries need to issue for the banks and at the sovereign level. And the word here is that even as we go into Q3 and Q4, we continue to see, in particular for Spain, but also in Q2, something for Portugal, that the levels of financing needs are still fairly substantial. So in other words, at the end of all this, this also gets to the US debate. If I'm a country, or if I'm an entity and I'd like to sell a bond to the market, if there are buyers, it's good, and I'll get a low interest rate. If there are no buyers, then I'll have to pay a high interest rate. That's why Greece at the moment is paying 20% because there are very few buyers. So that's why if I cannot get buyers, someone to buy my government bonds, I need to simply go back and improve my fiscal finances so that people want to buy it. And the US situation, of course, has gotten more urgent here now that the Standard & Poor's decided to put a negative watch on the long-term outlook for the US and saying that within the next 2 years we must have a more sustainable fiscal situation. One thing that differentiates the European situation from the US is that in the beginning of the crisis, every country literally in the OECD area basically expanded spending because they wanted to basically dampen some of the negative effects of the crisis. Later on, the Europeans, because of the problems in Greece and Ireland, have also basically moved a lot in the austerity direction and cut down both expenditures but also raised taxes and basically tried to go back to a more sustainable situation. The US really was left on its own because the other countries did do more austerity. So now the US has been more exposed, and this is really what Standard & Poor's are saying, in my view, namely that there is a risk that if the US continues to stand alone and everyone else is moving the austerity direction, then that exposure could just become more risky because financial markets may end up saying, well, now we don't want to buy US government bonds either. I don't think that's likely at all, but it just puts a lot of pressure on Congress to try to get together here some plan. And if anything, this is actually positive because it does tell that this is something that we have worried about a lot for a long time, and now Standard & Poor's is just pushing in the direction of saying, you have to do something, you cannot just ignore this for too long a period. One thing on page 17 that's very important in the European context is that you often get the question, why don't they just default on their debt and then move on? I used to work at the IMF, and there Argentina defaulted on their debt and they definitely moved on, and this to some extent helped them get out of their crisis. The problem is that when you think about why don't you just default on their debt, you have to ask the question, who are the holders of the European government debt? So what this chart here shows you is that for Greece, Ireland, Portugal, and Spain, combined, they hold 1.2 trillion euros in government debt. So you should ask the question, who are the holders of the Greek, Irish, Portuguese, and Spanish government debt? And the answer to that, as you can see in this diagram here, is the banks, the ECB, and the EU and the IMF. So these are the balance sheets, those that hold that government debt. The problem is that if I'm a bank or if I'm the ECB and I hold a substantial amount of government debt from some of the peripheral countries, the risk is that if they default or they only pay me back 50% of the value of the bond I have, I may be insolvent. So the risk here, if the ECB, for example, becomes insolvent, I mean, think about that, that's the same thing as if the Fed became insolvent. Then the ECB and the Fed would have to do the same thing, maybe call the politicians, or in this case for the Fed, call Capitol Hill and say, I need 100 billion because I just lost that on some investment I did in peripheral government debt. And of course the political environment will not be particularly good if you start calling politicians for recapitalizing the central bank. So there's a very serious issue here that, in my view, what is the likelihood that Greece, Ireland, and Portugal will default? That will only happen when the holders of this debt are able to absorb those losses. And at this point, that's not quite where we are yet. So it still seems fairly unlikely that we'll get to that point anytime in the near future.
So none of this has been marked to market?
There is a big issue between your banking book and your trading book, whether you have to do mark to market. But still, even if it's mark to market, it could still be that the value, if it goes down further in sort of a very severe financial crisis. For example, at the moment, more recently, Greek government bonds went up to 20%. And that means that the price of the bond just went down more. So the more sort of the crisis escalates, just like the US, even if you have mark to market, you just create a situation where the value of your assets just continues to go down.
I guess my question is if that should already be in the markets, right? So to the extent that it's known how much of this cross-holding exists?
Yeah, so there are two issues that you don't have to do mark to market in certain parts of your book as a bank. And the other issue is that if the crisis escalates, you have even more downward pressure on your assets. So it's very similar to the US situation when asset prices came down, many banks were simply not prepared for asset prices going down because their liabilities didn't move much. And if your assets go down like this, at some point your liabilities get very exposed and some people say, wow, you have many more liabilities than the value of your assets.
What is the climate in Europe for strategic buyers? So there isn't a Warren Buffett in Europe, but can people, sovereign wealth fund like Norway, jump in and do something?
Norway is not part of EU, so that they would probably not be. But I hear what you're saying. It's certainly there's probably been a lot of visits from European governments to sovereign wealth funds to ask for help, and the Chinese have very publicly said that they are willing to help and have been helping. The problem is that this is essentially when you have budget deficit, then as long as you have that, you don't only need help today, you need also help tomorrow, as long as the deficit is there. So in the next few quarters, and if you started out with a budget deficit like Greece at around 13% of GDP, it's going to take you in the IMF program, which is very optimistic, 4 years before you get back. So you need that help for the next 4 years, meaning someone who basically can come back in this diagram here and buy your government bonds again. The issue has been that, to a large extent, many domestic buyers in these countries, so pension funds and insurance companies, have bought more domestic debt. But at some point, they just have so much that a lot of these bonds are held outside these countries that you need also to have the rest of the world with you. But there's certainly strategic buyers, to your point, and there's certainly a lot of push to try and get them to support even more. Turning to page 18, one thing, of course, that's critical in this is also to think about, well, the outlook could be improved by the economy improving, and this is just the ISM or the PMI indicators for European countries, and it's clear that the euro area, the dark blue line, is doing well. This is particularly Germany is doing incredibly well, but if you look at the light blue, Greece, unfortunately, that's not doing particularly well, and that's particularly problematic when you are someone who's in crisis. You would like to see your economy come back and help the outlook. So what can be done? On page 19, one thing, of course, which needs to be done is just to basically help change the fiscal rules so that they get closer to what you have at the state level in the US, in some sense. So what the German finance minister said here a few months ago was that what I have quoted here, the basic decision was for fiscal and budgetary policy to be decided at the national level. If that's to be changed, then we can talk about it. So there's a huge opening here where the Germans are starting to think about what are the options in terms of changing EMU. And as the next quote says, in 10 years we'll have a structure that corresponds much stronger to what one describes as a political movement. So this is a process, and this process is important because it also tells you that at the end of this day, from an investment perspective, this consequences of this for the US are not dramatic, but there is this risk that if you think EMU is going to break up, it could certainly have very significant consequences for the global banking system. And that's of course something that one needs to watch when you think about the outcome.
How many years do you think this risk goes on?
So we were hoping that these problems, and the European politicians were planning to solve these problems in March. They didn't quite solve them in March, so it's a very difficult question to answer, but in some sense, Greek government debt going up, the financial markets coming back and being more stressed definitely puts the discipline back on that they need to find some solution. So in my view, I think it would take maybe 1 more year, 6 months to a year, that we still need to have a more ready political establishment to find out how exactly do they want this marriage to function going forward. Who is going to pay, who is going to be part of it, and how is the burden being shared here across countries. The risk, of course, is the moral hazard, that if you bail out someone and you basically allow them to continue to have huge budget deficits, then they will say, well, thank you very much, I'm just going to continue with that. So at some point you have to say, no, you can't continue with that, we need some rules so that you stop and you change your behavior and basically go back and do like everyone else. So there's a big issue here. If you help one student in the class and give them sort of candy here, everyone else would like to have the same set of rules. So that's the risk here, that more countries will come knocking on the door if you give Greece preferential treatment compared to the others.
I see what you said about the German finance minister open to EU fiscal union talks, but consistently over the last year, Chancellor Merkel has been basically saying, forget about it. That's what I read in the New York Times. Has she changed her position?
There's certainly a big debate going on. I'm not saying that it will be either or. I can only watch as it moves forward. The political process is very, very difficult to forecast. The only thing that I will say is that the costs of breaking up EMU are enormous. So in that sense, I simply don't think that's an option. I think that the only option is that they have to go into a room and they have to come up with a solution, as politically unpopular as it may be. Because if they were to break up EMU, think about what that would mean. If you lived in a country and it was announced that this country is going to leave EMU next week, then people in that country would probably take all their money out of their own banks and transfer them to money into a bank in the existing or the core EMU countries, where you would basically keep the banking system at the same level, and therefore the exchange rate from the country that leaves EMU would probably go down dramatically. That means that your banking system would see and run immediately that you saw such an announcement that people said that they were about to leave. So there's a huge issue here that if you leave EMU, you risk that the banking system and therefore your whole economy gets close to a meltdown, and it could get actually much worse than what we saw in the US during the financial crisis over the last few years. So there's a significant risk associated with this. That's why if you are about to leave EMU, and that's why the default issue also in this diagram I had earlier, I think that will only happen the day that these balance sheets are able to absorb. So the banking sector needs to be much stronger than what it is at the moment, in particular in the peripheral countries. Turning now, finally, to the impact on 21 on the US economy. One way, of course, to look at oil prices and the impact on the US is what we looked at earlier, namely on car sales. Another way is simply to look at retail sales, meaning consumption. So this chart shows you how much of consumption, when you think about consumption overall in the economy, goes to filling up your car. And as you can see, this chart here shows you in 2008, it was a little bit more than 13%. Then it crashed down to around 9%, both because oil prices went down, also because people drive much less, or drove much less during the crisis. But now it's back to a little bit more than 11%, so it's crawling up here. And again, a fairly substantial amount by historical standards that's been being spent now on filling up your car. And what's very important is that filling up your car obviously is quite different from buying goods and services which are much more productive and which create employment at the other end for the US economy. And that makes me
Is there a
to
price per gallon you think is something to pay attention to in order to get there?
absolutely. I think when we get to $3.50 or $4, sort of the psychological levels is again and again where we hear that people say, wow, have we really gotten all the way to $4, that it starts to be worrying. But that being said, every cent that oil prices go up is something that's negative because it takes directly money, as this chart shows, takes directly money out of buying products and services elsewhere in the economy. And the most, from a GDP aspect, the most unproductive thing to do is really to buy oil, because there are very few jobs associated with that. Whereas if I go and eat at a restaurant, or if I go and buy whatever new clothes, then that's also something that has many jobs associated with it. So that says if you take money away from those normal activities and all towards oil, it's bad for the economy overall. One final point I want to make on the US economy on page 22 is to think about oil prices are critical, but when you have to put it into the context of what does this mean for the overall outlook. And one thing that's very important about the US compared to all other countries is that the US, the business cycle, is what you see here in the blue line, is discretionary spending. So the blue line is only 20% of the economy. The red line is 80% of the economy. So if you want to understand where the US economy is going, all you need to know is what's happening to the blue line. As you can see, the blue line has been coming back, so we've had a rebound. But what's most important on page 23 is to think about what are the components inside the blue line. And what's inside the blue line is what you see here, namely four things. The light blue, which is essentially CapEx, business, fixed investment, equipment, and software. So this is CapEx, this is companies' investment decisions. The dark blue, which is essentially cars. So this is our private decision whether we want to buy a car or not. The yellow, or the orange in the down left-hand corner, is residential investment, so that's housing construction. And the red, which is commercial real estate, so that's apartment buildings, shopping malls, and non-residential structures. So at the end of the day, when you think about the recovery where we are at this point, the economy has really mainly been flying on the blue engine, namely CapEx and autos, as we saw earlier. What is the problem so far in this recovery is that we have seen almost no contribution to GDP growth from real estate because the housing market continues to be fairly subdued. And that's why the housing market and getting that engine over there to the left to start up is critical when you think about the timing of how the economy will do going forward. So that's why on page 24, the number one issue when you think about the likelihood of the economy coming back on the housing front is what's happening on the housing market. And what you see on this chart here is the dark blue line is the number of housing units in foreclosure. Currently stands at around 2 million. So we can quickly conclude that unfortunately the housing market is not quite healthy yet. So that's why if you are a home builder and you look at this, you'll probably be concluding I should probably wait a little bit with adding more homes or adding more construction. And that's why in this diagram here, there is a risk that we may take a little bit longer before we start to see addition to GDP growth coming from real estate because of the problems in the housing market still being here. In fact, on 25, when we look ahead and ask the question, how big is the shadow inventory? How many people are at risk of going into foreclosure going forward? So this is for the US nationwide. To the left, you see that the number of mortgages in the US is 47.8 million, about 48 million mortgages. Of those, subprime is 3.9 million. At the peak, there was 6 million subprime borrowers. Now we're down to 3.9. So we have already seen about a third subprime borrowers going into foreclosure. But the problem is, in the second column, that the 60-day plus delinquency rate, meaning how many are 60 days or more behind on their payments in subprime borrowers, that's about 40%. And for prime, that's 7.8. And if I multiply the first and the second column, you get that the stock of people, of subprime borrowers that are 60 days or more behind on their payments is 1.6 million. For prime, it's 3.4. If you add that up, you get that the shadow inventory, meaning the number of people that are at risk of going into foreclosure, is almost 5 million. And you can ask, how much is 5 million? Is that a lot or is that a little? Well, on the previous page, we saw that the number of people in foreclosure is 2 million. And now we are saying that there's 5 million at risk of going into foreclosure. This is unfortunately an issue that still, as sad as it is, has not gone away. And the risk, of course, is that this could put downward pressure on home prices. And of course, that's also something that will be bad for consumers and therefore also bad for the economic outlook. So just to summarize the economic outlook, and that is what we have on page 26. The imbalances in housing and banking are being corrected, and we'd like to see the economy growing faster as we go through 2011. I don't expect a double dip, but I see some substantial problems. And what are those problems? Number one, geopolitical risks. Confidence deterioration, meaning the CNN effect, could magnify the negative effect of oil on the economy. Number two, foreclosures could start to increase again. This risk putting renewed downward pressure on home prices. Number three, the commercial residential real estate problem may weigh on small banks' balance sheets for a longer period. This may hold back credit to small businesses, and this may keep the unemployment rate elevated. The countering argument here really is that these three forces, the geopolitical risks, the banking sector, and the housing sector, is basically being countered by the Federal Reserve, basically doing QE2 and trying to say, well, if home prices are going down, the only way the Federal Reserve can counter that is by trying to get the stock market to go up, and thereby by trying to get risky assets to do well so that it basically offsets the negative effect of the housing market. So as long as risky assets do well, that's certainly good. But the worst thing that could happen, of course, is if we start to see a downward movement again of both stock markets and home prices going down at the same time. Finally, investment implications on 28. What should you do as an investor? I think you should keep an eye on geopolitical risks, most importantly oil prices, then Japan, and then Europe. And then secondly, the sustainability of US recovery, especially ongoing recovery in the housing and banking sectors. And the investment implications in terms of asset classes on page 29 of this view that we have. On the Fed outlook, the rate hike has been delayed. High oil prices delaying the Fed hike. 600 billion in QE2 likely to be completed in full. Non-farm payrolls are likely to grow at plus 200,000 in the next couple of months. Bond market, long rates up as the economy improves and QE2 ends. Long rates are close to fair value and are poised to rise later this year on the back of the ongoing recovery. And QE2 ending in June will signal that the Fed tightening cycle has begun. Once Europe solves its problems, Europe is likely to lose some of its safe haven status. Stock markets.
Before you move off bonds,
Yeah.
loan rates are close to fair value. Can you?
Yeah, so that's, I didn't have that chart in here. So one way you could do that is basically to put a very simple statistical model where you say, where should 10-year treasuries be? And that could be a function of the two main drivers of treasuries, namely the Fed, so this is the 2-year rate, or the business cycle. So if you put statistical measures of the Fed's, meaning basically in this case the 2-year rate, and a measure of the business cycle on the right hand side of the statistical model, and you ask the question, where should 10-year treasuries be relative to what people expect about the Fed and where the business cycle is? And the answer to that would be, at least in our framework, that 10-year treasury should be 3.5%. So think of this as a predicted value as a function of some forecasting variables, and then the actual value. Where are actual rates compared to where they should be? So that's what fair value means in this context. I should say that this could be done in many different ways, but the way we have done it basically comes straight out of the Fed working paper, where people did basically the same thing, saying that 10-year treasuries are a function of the economy and it's a function of your Fed expectations.
So at the heart of that is a GDP expectation for 2.2, which is well below historical averages. If that were to rise, then fair value would be well.
Exactly, absolutely. And also at the heart of this is that the Fed has interest rates at 0. So if you think the Fed is going to hike, I mean, this is where the debate begins. When will the Fed hike? Because I was just a week in Asia last week, and I met basically say, I think the Fed will hike already in the third quarter of this year. Then long rates should definitely be much higher than where they are. Others say that the Fed will only hike in the Fed actually put out themselves a paper yesterday suggesting that they will only hike in 2013. If that's the case, then long rates will be lower for a lot longer. It's a fairly significant issue here in terms of what are your expectations, both to what the Fed will do and also to how the economy will be performing. On the economy, I think a lot of that rests then on what we have with problems in the housing market and these geopolitical risks starting to fade. But that's the discussion in terms of what the outlook is for long rates. Just for what it's worth, my view is, as you can see here, that I expect later this year rates will start to go up. So I don't think that this low level of 3.5% is something that we'll have for many, many years. I think at some point we will, exactly as your first question was, we will start to see a normalization both in GDP growth and therefore also in loan rates. Just on equities, the gradual recovery and ongoing monthly yield goes well for equities. The dollar, expected continued dollar decline once the European problems have been addressed. And commodities and emerging markets, we also expect to do well. And with that, I will basically stop there.
Any questions? It's all very clear.
You seemed a little tentative about the housing market.
Yeah.
Could you just talk a little bit more about that?
Yeah, there are many aspects that go into that. It really complicates. What I would like to have is simply just someone showing me, is this going this way or is it going that way? And unfortunately, as usual, it's not easy like that. So the problem at the moment is that we have a lot of foreclosures. And this foreclosure, we expect that to continue to, as sad as it exactly is, unfortunately continue to be a problem, at least for a few more quarters. The good news is that when you look at the data for household formation, so this basically is data for both immigration but also people who used to live in the basement with their parents and now have moved out, you have seen more recently that household formation is starting to come back. And that means at the moment we're running at a household formation rate of around 1.2 million. So this is the rate at which we're filling up homes in the US. So in some sense, at the nationwide level, you have to ask the question, how many empty homes are there? And one way that we quantify this is to say there's about 800,000 empty homes, and the rate at which we're filling up homes is 1.2 million. So that tells you that if I had 800,000, if I had 100 Coca-Cola cans on the table, and I basically came in every day and took away 2, it would take me 50 days to eliminate the stock. If I came in every day and took away 50, it would take me 2 days. So the rate at which I fill up homes is very important. And what's very unique about the US with immigration is that 1.2 million new household formations is filling up homes at a very rapid rate. And this really differentiates the US housing situation, that the US is definitely moving in the right direction. And that's why I think the US is not Japan, because in Japan the problem was that there was actually no population growth at all. The population was shrinking. And that means that if you don't have anyone to fill up the excess housing inventory you have, then you have the problem that all adjustment in the housing market has to come through home prices, which is why literally in Japan, since '89, home prices have basically continued to decline, even today up to this point, and they're now 50% below where they were in '89. So there's a major issue here. The horse race, to your question, is between we're filling up homes at a fairly rapid speed, but the problem is that we still have many people that are in foreclosure, and the employment creation has unfortunately not been strong enough to sort of help these people that are in this very unfortunate situation that are at risk of getting into foreclosure. So I think the bottom line of this is that this problem with the housing market being in trouble will continue for at least a few more quarters. And the reason why this then becomes important, that my timing is only a few more quarters and not a few more years, is that that means that that's when home builders here in the orange here will start to say, now we see improvement in the housing market, now we'll start to add more homes. Because remember, the home building industry used to produce homes at a rate of 2 million per year. Now they're producing homes at a rate of 500,000. I mean, that's an industry that cut their production 75% in a matter of years. I mean, imagine any other industry cutting their production 75%. So they're already producing at a very, very low level. So even a very small tick up would add to GDP growth, because the level of production is low, but growth is the change, and that's exactly what we worry about when we think about both the Fed outlook and also what's happening to the GDP numbers.
So how does that play with the commercial and industrial real estate in terms of growth? Now we're looking at jobs, expansion of business, etc. How does that play?
Yeah, so the good news, if you will, that CRE, commercial real estate, is, meaning shopping malls, apartment buildings, and industrial complexes, are generally on much fewer hands. So that means that you don't have to go to literally millions of homeowners and do loan modifications. On the contrary, you have much fewer players, and they tend actually to know each other, so you could pay, except in CMBS, but you could generally get access to and sit down and renegotiate some of these contracts, and that has been happening to a much larger degree than what you have on the residential front, where you have to reach out to 5 million people that are behind in their payments. The only problem with the commercial real estate is when you ask the question, who are the holders of commercial real estate, then the large banks hold some, but the small banks unfortunately hold a fairly substantial amount. And by large, I mean the 25 largest banks in the US. So the rest of the banking sector, unfortunately, holds a fairly substantial amount of commercial real estate. And the real issue, if you are a bank and you have some assets that are not performing, and remember commercial real estate prices, home prices fell about 33% from the peak. Commercial real estate prices have fallen about 45% from the peak. So that means that if you are a bank and you have an asset that has gone down almost 50%, then the risk is that you're saying, well, I have an asset that's not performing, so I cannot give out many new loans because I'm still so bothered or being dogged down by this issue that this asset is not up where I would like it to be. So it's mainly the consequences of commercial real estate is mainly in terms of what it does to the banks, and therefore where the bank's willingness to lend out, in particular to small businesses. Because the small banks account for a fairly significant share, maybe about 40% of all assets in the banking sector. And if the small banks therefore are holding back a little bit because of CRE, then the risk is that they may not lend out money to people who like to start fitness centers and coffee shops, etc. In fact, if you look at startups in the US, they account for about 4 million jobs every year. So if you don't create 4 million jobs because the banks are holding back a little bit, then that could really be a key reason why job creation has been so weak during this recovery. So it's a very important issue what's happening to commercial real estate also. Now, in general, it's a very important problem that we had asset prices, both the home prices and commercial real estate prices, have come down and really haven't moved up, but are basically moving flat and have moved flat over the last 2 years. At the micro level, of course, it's fairly problematic where these different CRE constructions are, but it's at the macro level. The reason why I worry about it from an equity market and rates perspective is because what it does to your question to when will then the red one, which is non-residential, start to add. The good news is that there's a little bit more evidence that non-residential is starting to move up before the yellow one here, but these things are incredibly difficult to quantify, but nevertheless something that's really important to keep an eye on, because again, I cannot emphasize enough, this engine has just not added anything to this recovery. And that's what we are basically finding out, what is the timing of this adding to this recovery, because at that point when this starts to add, I can tell you GDP growth will come back much stronger than what it's been at this point, and therefore rates will come back much more, and we'll also have equities continue probably to go up in that environment.
Any other questions? Thank you very much.
Thank you.
Thank you. Roger, you want to introduce GMO? Or is it background?
Sure. So I guess guess Larry just asked me to introduce GMO. This is a firm I have followed for years. Jeremy Grantham is probably a name that most of you know. Actually, Ellen should introduce GMO. Why don't I let you do it?
Well, as you know, we spent a lot of time with your asset allocation, which we introduced in February. And the two most important things sort of to think about on an ongoing basis are basically enhancing your return and reducing risk, but more importantly, what strategies and asset classes are out there that can help you over a long term really think about environmental issues and impacts on your asset allocation. So last month you had Bridgewater come in and talk about risk parity, which is a very interesting concept and really has you focused on not capital dollars, but your allocation to risk. And as you know, your portfolio is rather equity-centric. GMO has a little bit of a different approach. They're not big believers in risk parity, and maybe you could ask them a few questions in terms of their approach and why they, I know they have a strong view and a white paper on risk parity. So without further ado, as Ranji mentioned, Jeremy Grantham is probably the king or the big guru in asset allocation, as they have a higher quality bias. And without further ado, hello Drew. Why don't we let them have an opportunity to talk about that, how they look at environmental risk and how basically nimble opportunities can be thought about on a long-term basis in terms of asset allocation.
First of all, state your name for the record, and so that everyone is familiar with the representatives. Thank you.
We'll do so, and thank you for having us here today. My name is Drew Tammany.
My name is Edmund Bello.
My name is Mark Mayer.
I'll start the presentation. I'll talk just briefly about our firm. I think it's important to understand that. Ellen has done a nice job introducing it in 30 seconds. I won't spend too terribly long on the firm, but I'll do that part of the presentation, the first couple of pages of your book. I hope there are enough books to go around. I brought actually a few extras. Edmund, to my left, is the portfolio manager, and he'll talk to you about our views in asset classes and where we're investing and where we're not investing at the current time and over time, and then talk to you, as Ellen said, about our interest in being nimble on our clients' behalf. So he'll take most of the time allotted, which is how much, Ellen? How much time do we have?
Half hour, 45 minutes.
Half hour, 45 minutes, thank you. And then Mark, who's the CEO of the firm, will give us a few closing remarks as to how we're looking at the world as well. So I encourage questions as we move along, but a half an hour, 45 minutes will go quickly. Please don't sit on one. If there's something we're saying that you'd like to know more about, or conversely, if there's something we're saying you know everything about, move along. Please feel free to be active. So page 2 is a quick snapshot of our firm. I'm proud to say that it's the same firm that we put together so many years ago, 1977, because it's still a private firm. All of the owners work at GMO, and it's a firm that's built to make institutional clients happy, to work only for institutions. We have a whole series of mutual funds, but they're institutional mutual funds, and we'll talk about how they work in portfolios as Edmund gets into his discussion. But we work for institutions just like yours, and that's how the firm's been organized. We don't have wholesalers, we don't have 800 numbers only for institutions, and they're actually listed in the back, many of them. A value orientation, disciplined investor, who says they're not? Nobody, okay, that's a Me Too kind of statement, but we're not a Me Too kind of firm. We're a firm that is going to make investments when they're cheap. Okay, we're going to go to asset classes when they're cheap, and that's the whole theme today. From an educational perspective, what we think is the right way to invest based on cheapness. You can see we have 100 billion of assets, but very important on that page also is 40 billion of those 100 billion in assets are invested for clients in an asset allocation. So they give us that first decision, whether to invest in the US or not today, whether to invest in Europe or not today, stocks or bonds. Kind of everything in our toolkit except timber, which will show up later. And timber is not in these portfolios because it's tremendously illiquid. So we think it's inappropriate for an investment like this. It's a separate discussion, which we're glad to have if that were of interest down the road. So we're pleased that our firm is that firm that we put together so many years ago. Offices around the globe. It's headquartered in Boston, that's where most of us are, but investment centers around the globe. And the two unusual places on the map that a lot of people ask about, Rivera and Rotorua, are timber offices. If there's a question about the firm, I'd be glad to field it, but if not, it's time for Edmund to talk to us about page 3. Edmund?
Thank you, Drew. So I'm really here to talk about asset allocation, and in particular, how GMO thinks about asset allocation. And hopefully that will be somewhat helpful for how you think about the way you go about doing asset allocation. So, broadly speaking, I'm going to talk about 3 things. First off, obviously, is how we think. I think that's probably the most important of the 3 pieces. And that's where I'll spend most of the time. Secondly, I'll try and bring it together and show you a couple of examples of how that thinking gets distilled into portfolios. And then thirdly, perhaps try and bring it all together and see how it can be used in a more general sense in terms of how we see the world. So page 3 is probably the most important slide I ever address. The way the market goes around. When I first saw this slide, I thought, well, it's just a circle with some stuff around it. It's kind of not really telling me anything. But it's really explaining how we see capital markets, asset classes. And it starts at the bottom with the idea of replacement cost. It's pretty straightforward. Replacement cost is simply, why would you build a factory if you can buy that same factory cheaper in the marketplace? And vice versa. It's the fundamental relationship that we look at. It's the closest thing we have to a law of gravity, if you like. Now, that replacement cost over time, the market, sometimes that factory can trade at a higher value than what it costs to actually build it, sometimes at a lower one. And that's what we think of as arbitrage or mean reversion. Is there a force, there's forces essentially pulling back those values back to that replacement cost. The problem is the next piece, and that's really the timing uncertainty. We know an asset class is overvalued. The problem, of course, is we have no idea how long it can stay overvalued. To misquote a British economist, the market can stay irrational longer than most investors will stay solvent. And so that leads to the next piece. It's the client's patience. And as we all know, the client's patience is exactly 3.0 years. And asset classes can stay under and overvalued considerably longer than 3.0 years. And so that client patience leads to the top of the circle. And that is the only risk that matters in investment, it seems, is career risk. The risk that you'll get fired. And what this means is that most managers are much more comfortable picking securities within a particular asset class. You give them a mandate, you say pick stocks within the small cap universe, and that's exactly what they'll do. But ask them about what they think about bonds or what they think about something outside of their universe, and they're like, whoa, too much career risk. And so very few managers are actually willing to confront that risk head on, and they just transfer it back to their clients. Now, as a result, we think that risk is one that is the most handsomely rewarded, because it's a risk that no one, or almost no one, is actually willing to bear. Because no one, of course, is willing to bear that career risk, the risk of failing when everybody else is succeeding, it leads to herding and momentum, and of course, extrapolation, the tendency for the market just to extrapolate what's going on at the moment, rather than trying to think what's going to actually happen 5, 10, 20, or even 30 years down the road. And of course, that leads to market inefficiency. The fact that asset classes, not just individual stocks, but whole asset classes, become under and overvalued for considerable periods of time. What this all means is that the most important decision in any portfolio, from our point of view, is which asset classes at any given time are you exposed to. And are those asset classes expensive or cheap? So we put together what we call the 7 immutable laws of investing. And they're really just common sense. It's how we go about thinking about the world. I always wanted to put number 8 would be never get involved in a land war in Asia. But it's just straightforward common sense about how to think about the world. The first one is always insist on a margin of safety. Well, that's just what you pay for something is essentially what matters the most. And if you invest without a margin of safety, things have to turn out exactly right for you to actually make a return on that investment. This time is never different. We hear a lot these days about the new normal. We think of it as a rebranding of the old always. Be patient, wait for the fat pitch. Unfortunately, this is a baseball metaphor that is almost entirely lost on me. But the idea here is don't try and tickle your portfolio to death day to day, week to week, month to month, even quarter to quarter. These are really long-term decisions. This is when valuations are extremes. After markets have rallied considerably, for example. That's when you want to start thinking about changing your asset allocation. Be contrarian. A lot easier than it sounds. Risk is the permanent loss of capital, never a number. It's convenient to think of risk as a number. It's something that can be reported. It's something that can be tabulated. It's something that can be put into a spreadsheet, added to a report. But risk is never a single number. Risk is ultimately losing dollars that you will not get back. Be leery of leverage. I think that's pretty straightforward. And then, of course, never invest in something you don't understand. Pretty straightforward, pretty simple. So I'm going to just go through a few examples of these for illustration purposes. Always insist on a margin of safety is really, or all of these you can think about, the background to all of these is really, when you're thinking about asset allocation, make sure that value is foremost in your decision-making process. Always insist on a margin of safety. Well, back in 2000, Fortune magazine put together a portfolio of stocks they said tend to last a decade. And of course, what they did is they took the high flyers at the time, the past winners, and they put together a portfolio consisting of Nokia, Nortel, Enron, Oracle, and so on. You can see listed here. And 10 years later, you would have lost approximately 70% of your capital. These companies were all priced to perfection. They were priced for a world that was going to grow at unbelievable rates in their respective businesses. And if anything didn't turn out exactly perfect, you were going to lose. Page 6 is a little slightly longer term perspective. Back from 1881, the cyclically adjusted PE. This is basically looking at a PE for the S&P that try and smooths out the profit cycle. And of course, what we're seeing today, all the way over on the right-hand side, is the market is once again in the 10% of the time when it's the most expensive. And what we found is that historically, when the market is expensive, subsequent returns are low. Page 7 is how we try and do a little bit better than just doing a cyclically adjusted PE. We try and smooth out the profit cycle. We try and measure it ourselves. And this is our 7-year forecast for the S&P. We think the S&P is going to lose you about 10 basis points a year for 7 years. Essentially, you will have made no money in real terms over 7 years. How do we get there? What assumptions are we making to have such a dire forecast? Well, pretty straightforward. We think that PEs will go back to normal. We think profit margins will go back to normal. The market, of course, is doing the classic mistake, and that is it's extrapolating current peak profits indefinitely. And if there's one thing we understand and recognize in our valuation work, is that peak profits are exactly that, a peak, only to be followed by a subsequent trough.
Let me just quickly re-emphasize that we're thinking in real terms. Many like to think in nominal, so just add 2 or 3%, whatever your inflation assumption is. To this graph and another couple that are going to follow, we always think in real terms, so please keep that in mind.
And the reason for that is that's what actually matters to the final holders of the assets. That's what's going to matter in terms of your purchasing power. How many dollars or how many products your dollars will actually buy is only once you've adjusted for inflation. Page 8 looks at the current bond market. Yields closer to 3.5% today. This is a very, very simple model. It says the bonds on the left-hand side really are composed of a real yield. You can think of that as the cash yield, a term for expected inflation, and then a little bit of a premium for taking that risk. And so what we can see today is that bonds are priced for perfection. If we have any kind of inflation, not outrageous inflation, but just modest inflation, real returns from bonds are going to be very, very low, perhaps even negative. So that's for a margin of safety. This time is different on page 10. This is an exhibit that is close to my heart. We put it together back in '98 as the tech bubble got underway in order to gird our loins and remind ourselves of previous episodes of financial exuberance. And at the peak of every single one of these bubbles, someone who believed that the market was efficient would have told you, well, it could go up, it could go down. What we know is that at the peak of every single one of these bubbles, prices will come down. The uncertainty, of course, is always the timing. Is it going to take a couple of decades, as it did in the 40s for the S&P? Or is it going to take just a few months, like it did for gold in the late 70s? But this time is never different.
Can I ask you about gold on your page 10 here?
Yes,
So,
a flash in the pan.
Yeah, if I look at it, over real, seems like a little bubblish to me. What do you think?
Today? Absolutely.
Absolutely.
Again, the timing is uncertain.
I hear you.
Page 11, be patient and wait for the fat pitch. This is showing our forecasts for different asset classes as we published them in 1999. And at the time, we were widely ridiculed for these forecasts because we had 10% real for REITs for 7 years, actually for 10 years at the time, and we had a negative forecast for the S&P, a negative forecast of 2%. And just about anybody we spoke to said, well, how can you possibly have a negative forecast for the S&P? This is the risky asset. This has a risk premium. And our answer was that it's overpriced. And if it's overpriced, there is no premium. There is no margin of safety. So be patient and wait for the fat pitch. Wait for when things are attractive. And most importantly, avoid asset classes when their expected returns or their prices are very high and their expected returns are low. Be contrarian. If you do the same thing as everybody else, you will have the same returns as everybody else. If you want better returns, you will have to do something different. Be contrarian. Today, everybody loves equities. It's not a surprise. People tend to like or dislike equities as a direct result of how well equities have done in the past. No one seems to wonder about liking equities in terms of how well they might do in the future. And of course, our favorite, everybody hates cash. Of course, cash is going to eat up your purchasing power. Cash is going to give you no return. It turns out that cash is also going to be a pretty handy way of redeploying capital when asset prices are more attractive. Risk is the permanent loss of capital, never a number. We think about three risks really that are most important or dear to our hearts. The first is really valuation risk. I think that's pretty straightforward. Buying an overvalued asset really does doom you to low long-run returns. The only way you're going to get decent returns going forward is to buy cheap assets. Pretty straightforward. Fundamental risk, fortunately, you don't have to worry about too often. This is really the risk that those good businesses that you bought are actually going to go out of business because things are going to get so bad. Every so often it is a risk you have to worry about, but not too much. And then finally, financing risk, or really liquidity. The risk that the liquidity won't be there for you to actually trade the investments that you desire. Page 16, be leery of leverage. I think it's really quite self-explanatory. Leverage is tremendous so long as everything is going your way. It's not so great when it goes the other way. We think leverage can be used. It can be used carefully, but be very, very careful when you deploy it. As the investors of long-term capital management found out, I liken them to the turkeys before Thanksgiving. A month before Thanksgiving, they're all looking around saying, well, things aren't so bad, we're getting fed, everything's good. 3 weeks before Thanksgiving, everything's still good, and everything's fine until you drop off the cliff, and it's time to cook a Thanksgiving dinner. Never invest in something you don't understand. We had a lot of debate about putting an exhibit for this, but we think it's just left really on its own. It should be pretty straightforward. And so those general ideas together, as I mentioned earlier, really is how we think about the world, and what's running or leading or linking all of these ideas is really the idea of valuation and making sure you move your assets when valuations get to extremes. So where do we go from here? Given that we're moving assets, well, the first thing you want to do is try and find as many as possible. So that may mean roaming a little further afield than equities and bonds. It also means for our portfolios, don't be too afraid of concentration. Diversification only works when asset prices are mispriced up and down, when you have both cheap and expensive assets. Diversification is of no help when everything is expensive. And then finally, the ability to hold cash, or the ability to start increasing your reserves as asset prices increase. So how do we see the world today? I sort of hinted at it a couple of times earlier, and on page 20 you can see our current 7-year asset class return forecasts that are the building blocks we use for our asset allocation portfolios. This is kind of the dashboard, if you like, that we look at when we're trying to drive our portfolios. It tells us how fast we should be going, when we should be slowing down, and what to avoid. And what it's telling us today is that large caps are set to disappoint, small caps are set to disappoint even more. The one area we like, although it's really damning with faint praise at this point, is high quality, particularly in the US. High quality for us are companies with high profitability, consistent profitability, and low leverage. These are about the most boring companies you can find out there. The Johnson & Johnsons, the Procter & Gamble's, the Microsofts of the world. They're actually still cheap relative to the rest of the market. International large, developed markets, we still see a little bit of return there, but certainly not something that would get us particularly excited. Small cap internationally is the same as the US. And then a little bit more in emerging, although we do have concerns about emerging today that are not reflected in this forecast, but do get reflected in our portfolios. And then finally, our forecasts for fixed income. And I think it was Ben Inker at our recent, our head of asset allocation at our recent investment conference who put it most succinctly when he said the returns to fixed income today essentially suck. That's what you get with incredibly low yields, with a modest amount of inflation, is no return going forward.
So that is one forecast that is not terribly controversial on this page anymore, right?
I think so. Except those who really believe you're going to get an ice age type scenario similar to Japan, bonds are going to deliver pretty disappointing returns. Page 21 gives you a snapshot of where the forecasts have been.
Do you want to talk about timber? You seem to like timber.
Sure. As Drew mentioned, it is an illiquid asset, as I refer to it as a very slow burning asset. One of the things we like about timber is really it doesn't have a crop cycle. You grow corn, you have to show up and sell your corn once it's grown. You can't wait till next year and hope it gets bigger. With timber, you can. The problem with timber, however, one of the things you have to be very wary of, is that it is a very long-term investment. It is much more similar to the private equity cycle, for example, with a minimum of 10 years lockup. So it's not a good cash flow investment, but it's a very high yielding investment. So page 21 gives us a little snapshot of where we've been over the last couple of years. The forecast in green are where we are today. The forecast in yellow is what we thought in September of 2007. And the forecast in blue is where we were in February of 2009. February of 2009 was a great time to invest. Now, it felt absolutely horrible doing it, but the returns available were very attractive. Today, unfortunately, we're much closer to our return forecast of October of 2007 than we are to our forecasts of February of 2009. We thought at February of 2009, for example, that S&P 500 would give you about 9% real for 7 years. We didn't realize, of course, it was going to give you 9% real for 7 months. So the timing is always uncertain. The returns, however, less so.
But this is a time to re-emphasize the point of being nimble that we can do on our clients' behalf, because in February or the first week of March of 2009, we made significant investments in the U.S. It is the case that people think of GMO, and particularly Jeremy Grantham himself, from time to time, as a perma bear, never constructive on the U.S. market. That's not the case. We're just crazy about valuation. And so when the time is right, we do invest. And I think that's an important takeaway. How much did we put into the U.S. that week, Edmund?
We put in about $15 billion, I want to say, over a period of months, reinvested into equities.
So relative to a 60-30-10 allocation, where
So we got as low as 40 in equities for a 65. We moved all the way back to 65. Now that's not necessarily available to everybody to have that kind of flexibility, but even some flexibility around those targets can be very helpful when valuations are extreme. Page 22 just gives a kind of flavor of that 60-40 benchmark exposure on the left-hand side and where we're currently positioned. Today we don't see very many opportunities, and so we're a little bit underweight equities, but the equities we do own are very defensive, and so our portfolio behaves as if it has a lower weight. What we really do have a lot of today is cash and cash-like investments. Almost 25% of this portfolio is invested in what we think of as dry powder.
While you're fairly negative on bonds. Can you tell us a little bit of the makeup of your asset allocation bonds, strategic fixed income, and emerging country debt?
So emerging country debt is dollar bonds of emerging countries. It's a very small allocation. Asset allocation bond and strategic fixed income. Strategic fixed income today is primarily invested in Antipodean debt, which is essentially Australia and New Zealand, which are about the only two bond markets that we see as fairly valued today. Asset allocation bond, for the most part, hold tips. Where we have to own bonds, we hold our noses and own Treasury inflation protected bonds, knowing that if inflation does get out of control, at least we'll have somewhat of a smoother ride than in their nominal counterparts. But I think perhaps more interesting is on page 24. The previous portfolio we looked at was really constrained by its ability to move around relative to that overall asset allocation benchmark. If our clients say to us, look, we don't care what benchmarks are doing, what we have is an actuarial return assumption that we must meet. What we try and do is put together a portfolio we think is best going to do that with the lowest possible volatility, regardless of what asset classes. Regardless of the fact that the US may be half of the market cap in the world. We're just going to go where we see value. And in a portfolio like that, we only own about 40% equities today. And half of that is in high quality, mega cap, blue chip, non-levered firms, as I mentioned earlier, the Johnson & Johnsons and the Procter & Gambles. Very unexciting stuff. Now, we balance that out with an exposure to emerging markets and international equities, but that is a very low allocation. This portfolio got as low as 20% in equities in October of 2007. We're also pretty underweight, or have a pretty small weight, I should say, rather, in fixed income, only 20% today. And almost 40% of the portfolio is in absolute return, or very low volatility, absolute return, which we think of as dry powder to be redeployed when pricing is more attractive. Now that's what we can do for our clients, and obviously we can have a lot more freedom to move around in those particular mandates.
Edmund, can I go back to absolute return? So what is your return target relative to what you've shown us for stocks and bonds? This is not on the prior page.
So there's two pieces. There's the multi-strategy and the alpha only. The alpha only is just trying to get 150 basis points above cash. So it's a very modest target. What we really care about is to make sure that it's doing three things. That it's not correlated or doesn't move with the rest of the portfolio. It's of no use to us if it just moves when equities do or bonds do. We want it to move when the rest of the portfolio is not moving. Secondly, that it has very low volatility. And thirdly, that it delivers the 150 basis points. The multi-strategy target is 8% above a T-bill. But today, in today's environment, realistically, I think that is closer to a 4% target. And it also has the mandate of making sure it doesn't move with the rest of the portfolio, does it with very low volatility, and produces a return above cash. So this is a very low expected return. But in this kind of environment, where we think equities are actually going to lose you money, large caps, something that's actually going to deliver 4% real can actually help you sit out periods of overvaluation. So on page 25, just where do we stand now? These are the broad themes that we're playing in our asset allocation portfolios. The first one, I think I've probably banged the table quite a bit about, and that's to maintain that bias to high quality stocks. Small cap is very overvalued at this point. risky parts of the market are very overvalued at this point. Remember, we have a program designed to encourage people to consume. Quantitative easing is its name, but really it's just a program to try and drive down risk premiums and make sure that instead of saving, people go out and spend. And the way you do that is to make sure that the options available for saving are quite unattractive. And the way you make saving options unattractive is you drive down future returns. How do you drive down future returns? You drive up current prices. And you drive up current prices on the riskiest stuff, and as a result, the future returns are depressed. So make sure you maintain that bias to high quality stocks. Maintain an exposure to emerging markets, but be watchful. We're very concerned about the growth model in China and its sustainability. Bond pricing has certainly improved from last October, but it's still pretty unenticing. We need probably at least another 100 basis points, if not more, on the 10-year yield to start us to get actually interested once again. And then overweight more conservative, low-duration fixed income, which is essentially code word for cash. If you can, start building up cash reserves in balanced portfolios. And then make sure you have an allocation to conservative, absolute return strategies where available. Now I just want to spend the last few minutes thinking a little bit about how the way we think the world might be of help to you. It really comes down to, when you're looking at your asset allocation, make sure that no single asset class dominates your portfolio. In particular, when it's expensive, whether it's equities or fixed income. In an environment of overvalued asset classes, you may have to move a little bit beyond your comfort zone, but make sure that your expectations are realistic. Don't think that you can get equity-like returns without significant amount of risk, particularly when equity is overvalued. But returns of 4 or 5% real are achievable with modest volatility of around 10%. But be conservative. Real assets, timber we talked about, are a possibility. We think it's a very attractive asset class. But again, you have to be concerned about its illiquidity. So make sure you have plenty of liquidity in the rest of your portfolio. But it does make sense to have a modest allocation to real assets. And then finally, be as nimble as you can. And if you can't be nimble, make sure that some of your managers can. And what I mean by that is, if all of your managers are highly specialized in their particular area, none of them are going to ever tell you when they think their asset class is unattractive. It's against their economic interests. So make sure you have some managers who are shifting assets at an asset allocation level between stocks, between bonds, small cap, large cap, the US, so that you get an idea of what your actual managers are thinking about the underlying valuations and attractiveness of different asset classes.
Thank you. Thanks for giving us the opportunity to talk a little bit about asset allocation. I do want to make sure that we address any questions that are on your minds, and that I think in particular to make sure that our framework and our advice is presented, has been presented, and would be presented in a way that is helpful to you. That this enables you to do things that improve the allocation of your plan, and I think most importantly, deliver on the obligations to the beneficiaries of the plan.
Any questions?
So yes, Mark, if you can go back to your equilibrium page in your forecast, it's very hard with several $1 billion, $7-8 billion, or across our systems, 120 billion, to do any, other than sort of hire a GTA manager, we just can't be that nimble. And it's not just the size of the assets, it's also governance, etc. If you think about what trustees should do in terms of policy portfolios and then allowing discretion around policy portfolios, how does your idea of equilibrium fit into that framework? Meaning, how should we be building a policy portfolio using your equilibrium estimates and then, based on valuations, adjust for today's markets? How should we think about a framework for decision making?
You're absolutely right. The equilibrium is essentially another way of saying what's the fair return for an asset, for an asset class. What should I be expecting for investing in the S&P? We think of as a fair return to equities of around 5.7 real. At a couple of percent or more for inflation, you get to about 8% nominal. And it's relatively straightforward to figure out if equities are going to deliver that or not. Now, what we don't know is the horizon and the flight path. So when you think of 8% real per year, you're not going to get 8% smoothed every year. But on average, that allows you to build up a portfolio based on, or have a strategic allocation, if you like, based on those equilibrium assumptions. Then it's really a question of what your sort of targets or goals are in terms of trying to set that. But that's, I think the problem I often encounter is that then gets set in stone. That policy benchmark, for us at least, only makes sense if you then compare it to where are you today. So you may want to hold a lot of equities, or a reasonable amount of equities when they're fairly valued. You want to hold even more when they're cheap. But you also want to hold quite a lot less when they're expensive, and have a mechanism for making those adjustments. And for us, those adjustments should be based really on valuation. Does that answer your question?
Yeah, could you talk a little bit about the long-term assumptions, your equilibrium expected returns? In particular, maybe compare some of what you show on page 21 with the chart on page 6 for equities, suggesting that right now there isn't a margin of safety, and that if you take some of the high points, it took literally decades to get back and return the historical 20th century norms. But you seem on page 21 to only suggest that large cap equities are going to earn about 1% real, or 0.8% real less than they have historically. It doesn't seem to jive with the page 6 graph, which had a lot of multiple expansion through the 20th century.
So if you look on page 6, what you're really looking at is what we call a cyclically adjusted PE. So it's the average earnings over the last 10 years in real terms for the market divided by price. So it's a PE, but rather than looking at the last 12 months earnings, it's the last 10 years. And it's basically a very straightforward or simple way of looking at current valuations. And what we know is that historically, when that PE is high, or that cyclically adjusted PE is high, subsequent returns are low. And when that cyclically adjusted PE is low, subsequent returns are high. So the exercise we try and do on page 7 tries to get at it a little bit more, in a little bit more refined way in terms of where we are in the profit cycle. In the previous one, we're just saying, well, look, we don't know where we are, so we're just going to take 10 years average of earnings, if you like, and average them out. On page 7, we actually have some assumptions about where we're going to be in 7 years. We think a fair PE is around 15. We may be wrong. Could be 14. Might be 16. We know it's not 22, and we know it's not 12. So that's more of an anchor point. Profit margins. Long-term profit margin has been around 4.9% on sales. We think it's actually going to be a bit higher than that at the end of 7 years. So we're going to be around 6%. But currently it's at 7.6. You hear all the great news today about profitability being at an all-time high. Corporations are making more money than ever before. And people often assume, because they think of one company, they think, well, if one company is profitable, that's a good thing. But if all companies are profitable, it's actually not a good thing.
Right, but I
Because
guess-
the return on capital doesn't stay high. It actually comes down. What happens is prices fall. And that's why today, we're probably sitting in a room where most people have some kind of smartphone in their pockets, which 20, 30 years ago would have been incredibly expensive.
But I fully agree with your approach here, and it shows it over 7 years. I guess what I'm trying to get at is thinking out 20 years, 30 years, 40 years, the 21st century, where the dynamics are much different. We have emerging markets of large number of savers who are seeking to find real returns. Indebted countries from the 20th century that now have to pay it back. If you stretch this out and carry it beyond your 70-year horizon, have you overstated your expected equilibrium returns for the long term, from which you're measuring whether or not something's a good investment now?
So what you're saying is you think that going forward, because of a structural change, the equilibrium is not 5.7, but maybe it's really 4.7.
That's what I'm asking you, is I believe looking at your chart on page 6, the structure you use on page 7, and some of the numbers you show on page 21, that they don't, if I try to stretch your thinking out over a longer time period, I'm not comfortable that you're getting to what really is a 21st century view from a U.S. investor's viewpoint. And I guess I'm just curious in your reaction to that.
So if anything, we're actually being pretty generous going forward. So we think the risk premiums are actually narrower today. The people are more forgiving of equity market volatility than they were in, say, 1920. So we do think the risk premiums are a little narrower. People own equities more generally. So it's reasonable to expect that the premium people demand is a little bit smaller. But I guess I would disagree with the idea that this time is different because the US is now integrated into a global economy, that somehow the return on capital is going to change. There's one thing we know is that the return on capital over long periods of time is remarkably stable. And it's remarkably stable in situations like Europe where the entire capital stock was wiped out. In places like Germany that had huge human and physical capital destroyed, and in Japan. That if you saw through those calamities, if you were, the return on capital or growth stayed remarkably unchanged. When we look at valuations, what really matter are the cash flows that happen beyond 25 years. In fact, two-thirds of the cash flows of a company that go into its current valuation occur beyond year 25. And yet it seems that everybody is looking at over the next 6 months, the next quarter of earnings, when they're almost completely, at the asset class level, immaterial.
Thank you.
Any other questions? Thank you for your presentation.
Great.
Thank you very much.
Thank you for your time and attention.
So Doug, we got about 45 minutes before lunch. Do you want to have a bio break or just bang through it?
You said what kind of break was this?
A bio break?
A bio break. Oh, I think we should have a bio break. From every point concerned.
Good.
Okay?
Yep.
We'll break for 10 minutes, no more? Perfect. Okay? Thank you. Sorry.
There's everybody.
Oh, no, we're short some people.
There's Mark. Anybody else?
Larry, before you go on record, we're gonna start with, fixed income, right?
Yeah.
Yeah, that's
I think that, I think we can start now.
Yeah?
We're back on the record. We're gonna start with opportunistic fixed income.
Okay. We've been working for a while trying to figure out how to get some returns out of our fixed income portfolio. Because as you know, most of it is investment grade and governments. It's not doing very well. I mean, it does, the manager's doing fine, but it's, you know, earning us 3 or 4%, which doesn't really work, but it's what you gotta have in the mix. Okay, you have to have some in the mix, so, and we have this little bucket of opportunistic, which we want to expand, and it's expanded in conjunction with this whole, asset allocation discussion that we've been having. So, Mark's been working on this with, Eddie, who's back there. So Mark, why don't you walk us through this presentation?
Sure, so we just passed around color versions. If you want to look at the black and white version, it's in your book on page 57. As Larry mentioned, this presentation will look at the fixed income markets, and we will be recommending an increase in the size of the overall opportunistic fixed income program. But we're also going to talk to you about new types of investment structures for the program. You'll recall that back in 2008, we established the opportunistic fixed income program in order to invest in areas outside of the traditional fixed income investments, the public market investments that we had invested before. So if you turn to slide 2, you'll see a pie chart. And this pie chart approximates the investable fixed income universe. And on the right, the slice of the pie on the right represents the present Core Plus 5 core fixed income investment grade program, as well as high yield tips and convertible bonds would be there as well. These are the traditional fixed income sectors that are mostly public markets. Now, these traditional fixed income sectors represent about 30% of the overall funds allocation. And in addition, the managers are generally siloed into specific mandates where they have limited flexibility outside of those mandates. So if you take a look at the portion of the pie chart on the left, that represents about 40% of the overall investable fixed income market, and that's obviously a fairly sizable opportunity set. And that falls outside of the traditional mandates, and so that's why we established the opportunistic program to invest in that. And it includes distressed debt, it includes structured products, it includes securitized assets, it includes most private debts, and it also includes a lot of real estate debt. So the opportunistic fixed income program is what you see on the left. On the next page, we note that we have obviously fixed income in the portfolio for diversification equities. It also provides current income, but with the market conditions where we are today, as Larry just mentioned, the markets are offering historically low yields. To give you a flavor of where we are in the markets, the Core Plus 5, your investment grade program, that's about 20% of the overall assets of the fund, has a yield to maturity now of 3.5% as of April 1st. Your high yield portfolio, which you expect higher yields, is now yielding, yield to maturity basis, less than 7%. So in the opportunistic fixed income space, because of illiquidity, because of specialized knowledge that's needed, and because of inefficiencies in general in the market, investors can achieve a higher return. So if you turn to slide 4, we show what investments we've made in this space to date. And there have been 4, and each one of them have done very well. But you'll note that each one of these investments were made in specific funds that were raised to institutional investors such as yourselves. Each fund also is in a specific niche or targeted area of the market, such as RMBS, residential mortgage-backed securities, CMBS, or distressed senior debt. Page 5, we graphically show you where yields are.
These numbers here, the 25 million, is that what fire is committed?
Yes, so, yes, that's correct. Right, we show what the committed amount was, what the dollar amount is. The dollar amount may be a little bit different because some of the funds are now in the harvesting period where we're getting some money. So on page 5, we show a 10-year chart of the yields of fixed income. And we include the traditional fixed income markets. You see treasuries, investment grade credit, high yield. And as you see, most of the yields have come down to very low levels that are not attractive on an historical basis. Just to get an idea of where you are, if you take a look on the right, the blue and green lines are most of your fixed income assets, and those obviously are very low levels. But there are opportunities to make money in fixed income. So if you turn to slide 6, we list some of those areas, and they include corporate stressed and distressed investments, structured securities, and many private market transactions. Most of our investments are, of course, in public markets, but private market transactions can be very compelling, including the potential to buy distressed assets from banks in the US and Europe as they need to recapitalize and sell those assets off their books. But there's no free lunch, and with the increased expected return comes a higher level of risk, and we note some of those risks on the next page. And the first risk that we note is the most important, and that's volatility. Volatility of the returns will be higher. However, it will still be lower than what we expect public equity markets volatilities to be. To give you some context, the core plus 5 volatility historically has been in the 4 to 5% range. That obviously can go up as interest rates increase. High yield is higher than that. Public equities would be in the teens, upper teens. We would expect that these volatility levels would be lower than that. There is also other risks, including illiquidity. Many of these transactions or investments we would make are private market transactions. Now, on the positive side, though, in the opportunistic fixed income space, many of the investments would be investments where we would have more protections. We would have better collateral, more covenants, and in certain cases, a senior claim on assets. So you have a serious downside protection embedded in the investments that we would make. While the core plus 5 investment grade program, and to a lesser extent the high yield program, are in higher quality and certainly more liquid assets, there is significant interest rate risk, or is what we refer to as duration. And what that means is when rates go up, the value of the portfolio, even though they're higher quality, will go down. And we saw that in November and December when long-term rates went up, when the 10-year went up from 2.5 to 3.5, the value of the portfolio and the benchmark went down 1% each month. In opportunistic fixed income, specifically looking at distressed debt, floating rate notes, private market transactions, there's very little interest rate risk, but what you do have is credit risk, as well as liquidity risk and the other risks mentioned on the page here. Turn to the next page. We do recommend, as Larry mentioned, that due to the low expected returns over the next market cycle from the traditional fixed income programs, that we recommend that the board increase the allocation to the opportunistic fixed income program from its present level. The exact amount of the increase, of course, will be part of the asset allocation project, and we'll come out of that, and we'll be seeing that soon as well. To give you an idea of what we're expecting, you should expect 3 to 5% to be coming out that we would be recommending for opportunistic fixed income. But in addition to just increasing the amount that we're investing in this space, a very interesting and to us exciting area that we're working on with staff and consultants is to bring to the board investments in this space that are strategic mandates, where we work with particular managers to create separate accounts where the managers have flexibility and the expertise to move opportunistically into the areas where the greatest value is. Presently, we're in funds, and the funds are typically, as I mentioned to you before, if you turn back to the other page, they're in niche areas. Sometimes those areas become less opportunistic and other areas open up. And what we're working on right now and doing due diligence on is a project to bring to the board strategic or core mandates where the managers will have the ability to look at across the credit market landscape and invest accordingly where the opportunities really are. Now, when we do that, obviously, to create these core mandates, there are a couple of positives that come out of that. And some of those include the fact that we are going to structure this so we own the assets. They will be in a fund structure, but we will own the assets, meaning that Fire will own the assets, won't be in a fund. There will be lower fees, better terms, and this will help, we believe, invest more efficiently in those spaces and to be more nimble. In short, we'll have control of the assets. There'll be a better alignment of interest between us and the managers. And the managers will be able to truly invest opportunistically in real time across the credit landscape where they have demonstrated expertise and skill. And we'll go through that in our due diligence process. In addition, if these core strategic mandates are funded, the managers, in some cases, will not see opportunities. In those cases, we will encourage them to return the capital to us so we can deploy to areas where we see better opportunities. But more importantly, the managers will have the ability to recall the capital. So this is very different from the funds that we're in right now. Typically, the funds that we're in right now, there's an investment period. It varies. Could be 3 years, could be 5 years. But what could happen is we go into a fund, which is a wonderful opportunity, but it's in a niche area, and a year later, that area is now fully priced, but our assets are locked up. And what we're suggesting now in these strategic relationships is the managers would then have the ability in areas that they've demonstrated expertise in to move out of that particular area into other areas. In other words, to have a diversified portfolio and the ability to move dynamically as the market conditions change. This is very different from the fund structures that we're in now. So we believe that this will help allow us to be more nimble. But having said that, we will continue to bring to the board compelling opportunities in what we're calling the satellite or niche funds, the funds typically that we've seen before that we've put in this category, if they're compelling enough and they would complement the core strategies that we would bring to the board as well, we would invest in those as well, because there are opportunities with funds that have very specific strengths and expertise that we would want to use to complement the core strategies. So in closing, we're looking to increase returns in fixed income. We expect returns to be very low, and we believe that by increasing the overall allocation to this area, and by opening up and taking away some of the limitations of only investing in funds and now doing strategic mandates, we will have truly an opportunistic portfolio that will enable the fund to have higher returns, as well as help diversify the source of returns. We're very excited about this project. We've spoken, of course, with NEPC on this recommendation, and I believe they're also, I don't want to speak for them, but I believe they're also very excited about this. This is about as excited as we get in fixed income land. And the last item that I want to mention is that we will be bringing to you and circulating to you an investment policy statement for opportunistic fixed income for approval at the next board meeting. You should also expect that we will be bringing over the next several months to you investments in these strategic or core mandates, specialized mandates.
Mark, the numbers on page 4.
Yes.
25 million was committed, against the current market value is now 39.1 million?
That's right.
Okay, so then it's 15 million and the current market value is 11.3, so we lost on that investment?
No, not all the dollars have been called.
Okay.
They still have a couple of years to go. Actually, they have the investment period runs through next year. They have not called all their capital through December. They actually did make some capital calls earlier this year, but it's not. These numbers are through December 31st, so it didn't incorporate that. And with Avenue, the funds are actually Fund 5 is returning capital. As you know, that's one of the funds we would be recommending a RIA into, and that's one of the satellite funds or niche funds that we are talking about. So there is a mix of things. PIMCO, DISCO, the investment period is about to end, so we will be getting those funds back very soon. Avenue as well. Torchlight still has some time to go.
Okay.
Martin, on the strategic recommendation, could I ask that NEPC come back to us with a lot more sort of analysis on the return patterns in this category? What is the risk we should expect? How does it correlate to equities or to high-quality fixed income or to high yield? Give us a little more sense about the space. What are the 20, 30 managers in this space? Track records, what are the range of asset classes or types of investments, bank loans, mortgages? I appreciate this, but I feel like I need a lot more detail if this is going to be 2 to 5% of our asset allocation.
Now, when we come to you with specific investment recommendations, we're going to come to you to say what the space is, what the universe is, how we came to where we are. We'll talk about that when we talk about the specific investments. And of course, we'll work with NEPC to answer your questions.
Yeah, because a lot of what I'm asking for, I know you circulated an IPS for all of us to review. I think a lot of what I'm asking for will help us inform sort of what should be put in there in terms of risk, what should be put in there in terms of return benchmarks. A benchmark has not been proposed here. Just expected returns have been laid out. Are there benchmarks that we would use? How would we think about it? How would we know if some of these managers are taking on risks that, quite honestly, we don't even understand?
So each investment, we're going to have a specific benchmark and risk target, so we can talk more about that as we go through the IPS process.
Great.
Any other questions?
And relating it back to what GMO was just telling us in the last discussion, can you give us an idea of where good values are in this space today?
Yeah. I mentioned before in the several areas, in the corporate stressed and distressed, the credit markets, while they're open to firms who are credit worthy, there are a lot of deals from the 05 to 07 LBO vintage years where those maturities are coming due. So in that space, in the distressed space, there are definitely opportunities to make money in senior credit. There is opportunity to make money in certain private market deals, including assets that will be sold from the banks, including assets that will be sold from Fannie and Freddie. Remember, Fannie and Freddie are sitting on pools of assets that they right now are trying to figure out what to do with, but at some point it's going to come to the market, and they will come to the market at great discounts. So there is a very large opportunity set. In addition, we'll be looking at bank loans, leveraged loans, which will have a lower expected return, relatively speaking, to the distressed piece, but will also have a lot lower volatility to it. And we will be mixing these together to come up with a return and risk expectation overall.
There's also assets and securitized loans in Europe that the banks have and they have to sell, that we have no exposure to. That's coming our way, but we need managers to do that. So some of these managers that we have is with core partnership relationships would also be US and Europe. One might even be Asia as well.
So you can even see high
I'm
returns.
sorry, hold on. Reported to near the last part of what you said. If you could, you might want to repeat it.
I'm sure it sounded good. I don't know what I said.
There are opportunities in Europe.
Right, yeah. There are opportunities in Europe with some of the banks to sell either their distressed loans or securitized loans or asset-based loans, none of which we have currently any exposure to. All of which, if we had partners that were strategic partners that could move the capital between the U.S. markets and European markets, we could take advantage of. But again, when the opportunity is there, the capital can flow there. When the opportunity goes away, you can't. John, as you were mentioning the PIMCO DISCO returns, which have been terrific, the opportunity ended. They still have more money. And they're kind of running down the return curve. But I'm sure if we said, by the way, you can take that money and reinvest it in something else, we'd have that money reinvested in something else. But they had a very, very specific mandate. They attacked a very specific opportunity very, very well, but the play's over. What you want is someone like that, not to pick on PIMCO, but some structure that says, that was a good play, thanks, what's the next play? Keep the money because we believe that you can handle multiple opportunities and then move our money and our profits into the next thing. As opposed to, we have to sit here and pick, okay, PIMCO Disco was a great idea in '09, what's the great idea in '11, what's the great idea in '12? We can do some of that, but it'd be nice to have a couple of 3 or 4 core fixed income managers that can move it around as they see fit on a daily and weekly basis, as opposed to a new fundraising each time we see something. That's really the key to the whole plan.
So I really like that structure. I'd be very interested to understand how and when managers actually give money back.
Sure.
Does that actually ever happen?
Yes, people do. Again, they will if they know that on a week's notice they can have it back. Because what they don't want to do is sit on cash.
Because they want to be able to also protect their IRRs. If they're holding investments that are their second or third best ideas, they're not helping their own IRRs, which will ultimately filter down to us and say, they're not meeting our return objectives. And so it's in their interest to return the assets as long as they know that we will allow them to call it back when they have better opportunities.
So the corollary is sort of in a private equity or a private real estate fund. They don't take the money until they have an investment. The difference there is it's an illiquid investment, so they don't take the money, they find investment, it gets invested, and then only when there's a realization do you get the money back. But there's very little reinvestment opportunity. If you take something like Avenue, he takes the money when he needs it, and then he can reinvest proceeds. And they tend to keep it invested because it's liquid proceeds. But then when it ends, it runs off. The question is, why just have to A, run off? If you like the manager, why go back all the time? And B, there are periods, as you know, when there aren't that many opportunities at a threshold rate of return where they start to get incentive, and you're almost forcing your manager to do something with it. As long as the manager knows he can get it back, it's in his interest, as Martin said, you've got perfect alignment of interest. Don't hold it, because it's going to cost you returns and cost you money, incentive fees. Give it back to us, and we'll give it back to you when you need it. And again, if you get the right managers, they'll get it. And they're used to dealing with it like that. So that's the key is partnership, understanding, it's a commitment. Don't sit on cash just to sit on cash, give it back to us, we'll give it back to you when you want it. And it's sort of a dialogue. You can set up parameters, you can set up sub-asset classes that you like, but there is some dialogue that goes on between the manager and them because the mandate will kind of move with the opportunities. And so it has to be very, very flexible, but still you wonder where the money is. It's also set up as a separate account, so if you want to fire them, you can fire them. These
Will
are our
the
assets.
mandates move or will their investments move? In other words, our guidelines should be written such that they have the nimbleness to do this. We call it strategic, but in fact, it's a strategic decision to be tactical.
Yes.
So,
It's a
so-
combination. You don't want it to be so broad that you don't know where your money is. So you want to have big bands, so let them do their thing, but they might come to us with something that's not in their mandate. Let's pick something. Say someone had the money and all of a sudden Europe blew up the way it is now. It might not be in their mandate, but they might have a big European office and we just hadn't thought about it. And they say, hey, what would you think if we took, we're allowed to put 20% of the capital in Europe, but the opportunities in Europe now, we want to put 40% in Europe. That's a conversation because they just hit something. They just hit a couple of the guideposts, like, we'd like to be X% in the US or Y% in Europe, partly designed around what we thought they were good at. And since you met them, mandate's gone on 3 or 4 years, they've actually gotten a very good, sustainable track record in Europe. They made you a lot of money in Europe, but they've hit one of your constraints, which is, not more than 20% in Europe, or 20, whatever the number was. You'd want to have a dialogue like that when you could say, yeah, you're right, the opportunity's there, you've done terrific there. We'll change it, we'll amend it from 25 to 35, for instance. But you wouldn't want to give them carte blanche today to say, we don't care if the money's in the US or Europe. That's what I mean by it. There's a dialogue and you're kind of watching, they're talking to you regularly as most of our managers do. But when they start to approach something, if there's a very big opportunity, you do want them to take advantage of it. But you just don't want to have it so it's completely blind capital. Because you just might not like it like that.
So speaking from the board's perspective, then, we will have an investment policy statement which has guidelines and ranges for these things.
Yes.
But one interpretation of what you just said is that BAM may have individual guidelines with managers that are more restrictive.
And we're working
But
on those now.
when you change that manager's guidelines, you still have to abide by the IPS restrictions.
Oh, yes. Yeah, but each one, again, each of the manager arrangements has a set of guidelines that's within the IPS. Everything's inside the IPS. All I'm saying is that the arrangement you have with the manager might be revised to take advantage of opportunities that arrive within the IPS. It's always within the IPS. But again, when you're trying to take a very broad swath of what I'll call debt real estate, it's a wide IPS, as we'll find out. It's going to have a lot of things in there, and you say, well, gee, that's all fixed income, except for, say, governments or government mortgages. Because again, what Martin just mentioned, you can put in there, it's a lot of stuff, which is why when you pick the managers, you're not going to give them all the exact same mandates. You're going to pick different managers with sort of different mandates.
But for the core, I mean, I'm thinking of how will we know if people are doing a good job or not? I thought for a while we were saying that you have 4 managers that are strategic relationships, give them the same guidelines and see who does well.
No. It depends on their individual strengths, what their expertise is, what their track records are, and it's sort of a jigsaw puzzle to put together to say these folks do these 3 areas well, these folks do these 4 areas well. There'll be some overlap, but we want exposure to one area. These guys can do it for you, but they really haven't demonstrated that, so we'll limit them to the areas that they've demonstrated their track record.
So the onus will then be on BAM to help us as trustees with when manager performance is very deviant, what are they doing,
Yes.
and are they meeting our expectations? And I come back to, please be very, please help us understand very clearly ex ante what your expectations are for the asset class and for the individual managers, and how you expect them to perform over time and why. That would be very important for us.
Yes. And again, each partnership, if you will, with a manager is going to have what I'll call this debt real estate. And you're going to see what boxes he's supposed to operate on in. So there's geographic boxes. One could just be U.S. only, stressed, distressed, corporate, and real estate. That's a box. There's a bunch of different things, inside those boxes, but just U.S. Another manager might be just as good as that first manager, but be global. So he'll have a global mandate, the other guy only have a U.S. mandate for kind of things that look the same. There could also be a manager that is just as good, but doesn't do real estate. But does U.S. and Europe, stressed, distressed, no real estate. So that's 3 managers now, 3 different mandates, 3 sets of boxes, all with their own unique guidelines of, if you're the corporate guy, we don't want you to buy us any real estate debt. That's just not what you've got, that's what the other guy has. And their compensation relates to the guideline, and it's all inside the IPS umbrella, which says opportunistic with lots of boxes. And the reports that you'll get from BAM on a regular asset class update will be, here's where the money's gone, and here's how they're doing, and here's where the opportunities have moved, and here's where capital over years has moved. So it might have migrated from, I don't know, pick a number, 70% was in the US, and you wake up 3 years later, half of it went to Europe instead of 70%, because the opportunity moved to the European banks divesting of their assets. And you'll see it, but again, that US manager only, he didn't participate in it, the guys who do US and Europe participated in it. All that conversation will come across when we go through how are these managers doing. And the answer is, here's where they're making money, here's where the opportunity moved, and here's where the capital moved. But the good news is, since they're all separate accounts, if someone all of a sudden isn't performing, we can take our assets and we can terminate them. Unlike the funds that we've invested in, we can't get out. So this is a liquid strategy in general, because there'll be also opportunities, as Martin pointed out. There's some very nice opportunities now in the U.S. in private mezzanine debt. Now, we can invest in a mezzanine fund, but that's just a fund, and I would probably tell you the opportunity set isn't 10 years. So let's have one of these guys who's in the traffic of all this be able to invest in privates as well. Fine, they can do that as well. But again, it's all in the IPS, it's all in the guidelines, it's all risk adjusted because there's different risks in all this. But it seems to us it's a great opportunity to let managers do what they're best at, which is make us money in a broader fixed income basis than just trying to pick the manager for the one little piece of the market, which is kind of what we've got now.
And it's more than that, you have to wait till the fund is actually being raised in the market at that time. So you have to wait for the timing to be just right. Here, we could be nimble in real time.
We don't have to be nimble in real time anymore. The manager's the one who's nimble, which is key because, again, if you're, one of the problems with this much capital is we only react when someone comes to us with a proposal, and then we have an RFP process. This is actually letting someone who we trust, who we've gone through a process, move with the markets. So therefore, he's probably 6 to 9 months ahead of where we would have been because they're moving with the markets as opposed to moving with the products.
See, I'm not with you on the trust part because I'm not sure how we're going to think about the risks when so much is shifting all the time. As CMAC knows, just on the hedge fund, we had to get very comfortable with Axia's risk reports and how they were going to show us risk on an ongoing basis. Are we working with NEPC? Are we working with Axia? What kind of reports will we get to show where these positions are moving around, where there's embedded leverage? And I have no way that, and I know Adi is here too now, but I just don't know how we'll keep up with what these guys. I get the excitement on the opportunity, I just don't understand our core competency on risk.
Well, I think NEPC can play an important role in that, in terms of working with Martin and the fixed income group, in terms of monitoring the risks, the opportunities, the overlap, and all that. We can, I think, put together a reporting template or a format that basically addresses everybody's concerns and update that on a quarterly basis to give you some consistency so you know as you progress where, as Larry says, the boxes are, who's shifting, where the money's moving, what inherent risks are embedded.
It's really just, it's in its simplest form, it's a classic fixed income separate account. That's all it is.
With subcategories that we have never invested in before.
No, we have invested with different managers for each one. This is just, why do we have different managers for it?
This risk profile is very different from the core fixed income that we've done so far.
It's in the opportunistic bucket.
Right.
So for instance, you have Avenue who manages some, you have Pimco Disco who manages some, you have some private equity guys like Apollo that do this for you. So it's scattered about in different pockets, correctly or incorrectly, but it's scattered about. So the answer is, A, you get more exposure to it, but B, don't try to pick the opportunity when it shows up, let your manager pick it for you. The reporting, we'll come up with the reporting for you, because it's reporting and following the risk is very, very important for the size.
You're gonna come back to us next month with this, right?
What?
You're gonna come back to us next month?
Oh, absolutely.
Yeah.
Next month and the month after. This is the beginning of a process. We've been working on it or getting our arms around it, talking to managers for 6 to 9 months. You'll see. This is good stuff.
But I just want to address something Larry said. There are great opportunities in Europe and we don't have the exposures there. And partially the reason we don't have the exposures is because the capital markets in Europe for credit never developed the same way that the U.S. capital markets developed. There is no high yield market the same way we have here. Typically there are loans made by banks and the banks now need to divest of those loans. So that's where the great opportunities are in Europe.
And I think I know the answer, but distinguish this from what we might do in hedge funds. How is this different?
This is primarily long-only We're not going to use leverage on a fund level. This is, I think, very different strategies from what SEMA ultimately will have in her program.
Yeah, I mean, the biggest difference we talked about with Avenue is that Avenue doesn't short. Okay. They just have a different strategy than what we'll find in the hedge fund managers that we talk to.
But more on it, we'll come back.
Okay.
Any more about the opportunistic fixed income? Okay. So that gets us to Corpus, near and dear to our heart. You want to hand this out?
Yes.
Dad, did you have an announcement?
No, a little later.
We will later. Important announcement. It's about that.
Yes, it's the same thing.
It might be the opposite.
Jesus, they have that we're the happy, right?
Yes. Everybody have this?
No. They all have it.
All right, good. We all have it. Let's go. Okay, so as you all know, Corpus is how we fund BAM in the simplest way. So if you go to page, not numbered, page 1, Corpus was set up in 2004 as a way to fund BAM directly from the pension assets.
Say that again, it's where the funds,
It's the way to fund the Bureau of Asset Management investment professionals directly from the pension assets, as opposed to through the annual budget, the city budget. Although, David, fire's a little different.
Not for, not for this. Not for this.
Okay. So it started in '04. So if you go on page 3, this is the staff of the Bureau of Asset Management. When I got here, there were 37 approved Corpus positions, of which 26 are on this page, 18 were filled, and there were 8 vacancies. So the organizational chart hadn't even contemplated the entire buildup of the Bureau of Asset Management. Go to the next page then. I looked at it and said, well, we need to have 17 additional positions, which you identified, and put job postings up. That got us to page 5, and you can see that we've hired 7 people, all of whom you've met and know, all of which are busy working on the funds, all of which are very experienced investment people. That led to page 6, which are the open positions that we have posted. We're in the process of hiring 2 real estate people. As you can tell, they've got great experience. We've got 5 that are posted, have been posted for probably 6 months now that we've yet to fill. And then we have 3 that are related to risk that we're waiting to hire the head of risk. But pretty soon we might just post these positions. We might just get on with these hirings because we're going so long we can wait for the head. We might have to get some arms and legs before we have a head. Then in connection with the asset allocation, you get to page 8, we need to continue to build the staff out. So as you know, we approved hedge funds. SEMA leads the hedge funds. We've got NEO, but we need to continue to build out the team. So there's 2 more hedge fund people that we need. Martin needs a couple of people in fixed income. In private equity, we ultimately want to build out so we can do some co-investments because we've got these $12 billion of commitments. We can do co-investments, which are no fee, no carry investments, but we have no one to look at it. So we first have to find someone to look at it before we even think about it. Same thing with infrastructure. We have a deal flow in infrastructure deals, but no one to look at it. So at some point, we'll come back to with how well that might work. Yvonne needs to hire a junior person for real estate to go with those 2 senior level people that we hired. And again, in the asset allocation, there's some amount of real assets and commodities, and if we're gonna do that, we'll need a team to build that out, just like we were building out the hedge fund team. So that's 10 new hires. So that gets you to page 9, which is sort of a build out of the team by asset class. So again, this is sort of a recap. If you look on the first column, we started with 18, we've hired 6, we got 10 openings due to the asset allocation I just walked through. We have 10 that are posted and not filled. Then we have the new asset allocation hires, another 10. So ultimately, we need to get up to 44 people to manage what's now about $118 billion. We benchmarked it and compared it to other public pension funds, and we have basically, we're understaffed and have about twice as many assets per investment professional as people who are similarly staffed like that. So, in fact, we can hand that out. You want to hand that slide out? Just to give you some comfort that we're not staffing for this. Sorry. Give you some comfort. As to the appropriate staffing levels. It's pretty dramatic, actually.
Thank you.
This is the top public pension funds in the U.S., starting with CalPERS down to Tennessee. They're in declining order of assets. The yellow ones are organized like us in that they don't manage any money in-house. Everybody else sort of has some assets that they manage in-house, whether it's trade stocks or trade bonds, or do their own private equity. So yellow is the correct comp group. If you look at the third column of numbers, assets per invest professional, this is really taking the 18, dividing it by 112, you get to about $6 billion per person. Whereas if you look at the other yellow guys below, it's like $3 billion, $3 to $4 billion per investment professional. We also are more complicated because we have 5 systems as opposed to 1 system. So it's clear that we needed to beef up the team. The team was understaffed. So this gets you to some number like the number and the team that we're building back together.
Larry, could you break this down a little bit for us? Because in places like public markets where we are so heavily indexed, by definition we would need fewer people. So could you do the assets or number of managers by public and alternatives?
I'm not sure I understand your question.
Because of our heavy passive exposure in public markets, we just need fewer people there.
Yep.
I'm not sure if the ratios of 6 to 10, which will change, or 6 for public and 10 versus 6 and 20, or 8 and 20. I mean,
Yeah.
I'm just trying to understand where the most active risk is in our portfolio, and is that where the resources are going?
Okay, I'll come back.
Okay, thanks.
So that gets you to page 10. Page 10 is the built-out organization of the Bureau of Asset Management. And you can see that starting on the left, Martin, and again, the green are the vacancies. Martin gets a built-out team as opposed to just he and Addie, Karen. Addie being brand new, so it really was just Martin and Karen doing a spectacular job managing $35 billion of assets. And again, you can see Martin's team, you can see Seema build out her team, you can see Yvonne build out her team, Barry's team, real assets team to be named, and ultimately get a team for managing the risks and compliance. In addition to them, there's some accounting needs and some contract needs. There are another 8 people, which if you look on page 12, you can see, again, as we get more complicated and as the assets have grown, and the number of managers have grown, we need to have more accountants. For instance, we don't have a hedge fund accountant. If we're going to do hedge funds, you got to have an accountant for hedge funds. we haven't hired a number of accountants as we've grown private equity, so that's stretched. It's just time to do a little backfilling for people to make sure that all the numbers sort themselves out correctly. And you can see on page 13, this is David Jetter's world. You can also see where the accountants drop in a little bit. Again, the bulk of it is we've just not kept up on alternative investments nor international. And again, capital's going international. We need more accountants. So that gets you to page 14, which is the totals. So this page is set up. The first column is people, the second column is total, the third column is fire share of the cost. So again, back to the beginning, there was a staff of 25 people that cost $2.3 million, of which fire paid $151,000. We added 6 people to date for $640,000, of which fire paid $42,000. That gets us to where we are today. 31 people, $2.9 million. Fire about $200,000. The additional posted hires are $650,000. The approved corpus hire, the things that are in this paper, the planned additions, 37. That's another $3.5 million. Another $236,000 fire. So that you end up with a total of $5.6 million for the city, $370,000 for fire. If I look at what that's compared to, it's really take it up to the. I guess you should probably take it to the 2 lines above. So you go from fire being $236,000 to $370,000. So we've gone to the other boards, the other systems, same presentation, everyone has a different share. Talked to OMB, so we're kind of working through this. Want to make sure you're all aware of it and okay with it. This is moving toward the right staffing to manage this large amount of assets. Any questions?
An observation you have heard from me before, but I will say it again as a fire trustee. Asset allocation is the single most important thing we can do as a board. And to not have it on the org chart, to not say that this is the single most important driver of returns and what the board should be thinking about, not to have an internal resource is just very distressing. Risk, as we get into hedge funds, as we get into distressed, as we think about commodities, is a huge function, and to see investment risk combined with compliance risk is also, I think, very confusing, because I think of those things as being very separate functions. I can't think of one senior quant I know that would want to apply for a risk function that would want to have responsibility for compliance, because it's an operational legal issue as opposed to really thinking about investments and markets. So I am just getting more and more anxious after a conversation that we just had about distressed, that we are underplaying, underestimating how much this board and all as trustees we need from BAM on those 2 issues, asset allocation and risk management.
What are you suggesting, that an office, a director of asset allocation? Or?
Yes, that it makes sense to us that asset allocation and risk management be one of the most senior positions reporting to Larry. If you think about what staff says to us on every single manager that we go to see, if they don't have a strong independent risk function, if that risk function is not embedded in the culture, we won't hire them. I think we need to create that. We can't have that metric outside and not have that culture inside. So yes, I'm suggesting a senior headcount for
Senior
headcount,
headcount.
body, person, for asset allocation and risk management, and separating the compliance and investment risks.
Well, there is a position that's not filled, the director of risk.
Right.
So you're suggesting creating a new office of director of asset allocation, that's correct?
Well, I'm going to leave it to Larry to how he creates it. to me, the asset allocation as a function is a full-time function. There's more going on in that field, or as much going on in that field as there is in credit. I mean, I feel like we spend a lot of time on small decisions within asset classes and are not focused on something that drives 90 to 100% of returns, which is asset allocation. It's a full-time function that either, as Janice knows, having done this herself, the CIO or deputy CIO of a pension fund, and Ellen can chime in if we are wrong, actually manages at pension funds. And something with our size, with 5 systems, it's very hard for me to fathom that that role isn't here. So yes, be very specific. Broaden the risk management into risk management and asset allocation, but don't combine compliance with that function, because that's a legal operational function, compliance.
I don't agree with your characterization of compliance. I think risk is more than just asset allocation risk. Risk is counterparty risk, compliance with the manager's risk, risk across all the asset categories, leverage inside our managers, legal risk, back office risk. All that is what a head of risk actually has to worry about. And I think if you look at best practices, there is a person who's in charge of systemic risk of the pension fund. That's your head of risk. That person has working for them people that are quants, as you put them, but people that are more numerically oriented, that worry about the financial risk, can have asset allocation in their cupboard as well. It's not legal risk. Legal risk is, we delegate most of that to legal on the one hand. On the other hand, there's a lot of risk that can bite us badly that someone has to think about, that is the risk person. So I could give you a page that has the names, 25 different risks that someone is supposed to worry about. Now, I can worry about it, but I'm supposed to have someone who is Mr. Risk or Mrs. Risk, who worries about every kind of risk possible that's related to these assets. That's the head of risk. The head of risk is not just a quant. If it's just a quant, we're going to find out that we have other risks that we didn't even think about that are going to bite us. And the answer is, well, who was supposed to think about it? And that's the gap between quant risk and legal compliance risk. So I'll come back to you once I find my head of risk, who I'll be sure you'll interview before I hire him, or her, and that'll be their mandate. It's the entire geography of risk. Inside that risk are subcomponents of risk. As to asset allocation, we work with our consultants, we work with NEPC, so it's a little bit outsourced today. It will be more and more insourced as we get more and more up to speed. Recall that prior to my arrival, there hadn't been asset allocation in 5 years, so Rome's not built in a day. But I agree with you that 90% of the return is asset allocation. So once we get into the mode of the first asset allocation, we will have it as a continual part of our thinking, which is why it's in our monthly report. Everyone should see it, think about it, talk about asset allocation, move it when we want to move it, but there's the long term, as we talked, there's long term, there's tactical, there's medium term. So I think that the asset allocation right now is in development, a little outsourced, actually mostly outsourced. Should be more insourced, subject to a little bit of budget constraints. I'm not sure I would find an asset allocation person, per se. But I would put all that up buried, not buried, I'd put asset allocation partly between me and risk as one. And it might end up as a deputy for all I know, but to be honest, I'm still trying to make sure that we have the screws and the doors and the rooms of the house built out right, because I think we're completely understaffed. We can't invest the capital. So I think we have to do that. While we're thinking about asset allocation, we're changing the asset allocation. While I'm trying to solve what I think, when I first arrived, was the biggest gaping hole, which was there is no risk. So I'm totally with you. We just need to find some way to do it. And it might be we have to wait on the head of risk because we need to find the financial risk person first, the investment risk person first. We have someone who's temporarily doing risk and compliance, and to be honest, it's such a big hole that we might just get to hiring a compliance person before we actually hire the person boss, and we'll just have to find our way through it because there's a lot of compliance things that are just not. Sure, there are a lot of compliance. We have to get you to sit down here next time. There's a lot of compliance things that are just not getting done the way I think they should be done. But it's in process. It's all in process. But it's subject to the budget. So until we get the budgeted positions, we can't hire the people. We can't have the job postings. So
There are many ways to get to the right answer, Larry, and this is not, as long as we have this, the seriousness of the function, how you fit it into your organization is up to you. But as a trustee, I have to tell you, we are not focused in terms of BAM's resources on best practices in an area that drives 90 to 100% of the returns. I just continue to say there is so much research and so much, the world has changed. Mean variance hasn't worked. What are the various ways to think about this? I really would feel, I urge you again to rethink the absence of a head of asset allocation on this org chart. And I'll leave it there. I think I've said enough. I do want to compliment you for the incredible talent you have assembled on the side of the table. But there's another elephant in the room. And the elephant in the room, which I know has something to do with why you haven't been able to hire the risk people, is compensation levels. And I just, having seen the plan and what you have proposed for a risk person, or for that matter, for any of your senior people, I wish this were bolder. I wish I completely understand the constraints that we have across the system. But when I think about 120 billion and we don't have a risk person, and you have said historically some of it, a lot of it has to do with compensation levels, I feel like we can have a position on an org chart and never fill it because we are unrealistic about what it will take. So I fear that this plan isn't realistic based on where even passionately public servants would want to come in and do this job for us. So my fear is this is just a head count that we all can agree behind closed doors we actually will never fill at the compensation levels we have. So even if it were on that position, or you know, I think we need a more honest conversation amongst ourselves as trustees, perhaps without staff to not make it awkward for people. A true executive session where we talk a little bit about these and you share with us some of why we haven't filled this risk role for such a long time, why it took people with tremendous passion for public service to come here. And my biggest worry is we would like to see people in these org charts who will be here for 5, 10, 20 years. We can't rely on a lot of people having Martin's ethic and willingness to do this. So
I'm afraid, Ranjit, I violently agree with you.
Well, I definitely think we should have an executive session where this is discussed, but I also think that obviously it probably involves certain legislative changes for city council, probably, I don't know, but whatever those possibilities are, because you're managing a lot of money, and it's very important to all of us, you know, that it's done right and with appropriate compensation, and to the extent to which that would be an exception within within some city compensation laws, regulations. I think it should be adjusted. There are exceptions.
I agree. I mean, compensation is our biggest problem.
Do you know whether that has been pursued in the past?
I don't know. I look to David and Martin and Dad as the keepers of history.
Well,
Been various discussions.
there have been various discussions.
Yeah, different ways to approach it, yes.
Well, you know, I think this is the time to do it, frankly.
really hard to do, but we should at least
Yeah, that's a heavy lift.
have that
but it's-
conversation.
It's something that obviously has to be done. You know?
But to your point, specifically one of your questions, Ranji, I'm gonna find a risk person, because I'm desperate for a risk person. And I'm gonna come to whoever I have to come to with the bill for that person. And say, this is what the posting said, but this person who we found is gonna cost this. What are we all gonna do about it? We could all say, no, you know, this person is nice, we found this person, they cost X, and they won't work for Y, because Y is a job posting, and what are we all gonna do about it? The answer is, well, it's too bad, you gotta throw the fish back in the ocean because we can't afford it. Well, that's the decision we'll all make together. But I share the question. I don't have the answer.
Neither do I.
You don't think that this is not just a question of the board making a decision about this, right?
No, I know, it's not a board.
Right.
I don't think it's a board issue.
Right.
I don't think. No, it's a, and again, new to how the city runs things. These are the budgeted positions. So we went through, we go to OMB, these are the positions. This is the current compensation that goes with these positions at these levels. Whether you can fill it or not, time will tell. I did work with David in figuring, going through the past history, these 37 positions have been, as Roger points out, on an organizational chart since '05. The maximum filling is 27 or 28. So somehow it's never been filled. Now maybe it wasn't ever as big a priority as it would be for me to fill these positions. And it might just be comp, it might have been lack of retention, it might have been a variety of things. I don't know what it was, but I don't know how to execute the plan that we're going to develop with the asset allocation without these people as the assets have grown, because these are now the biggest amount of assets we've ever had. At some point, you've got to get the team to manage these assets. So,
You need a motion to,
what do you motion?
you need to get with Larry.
We need a motion to do what?
We need a motion to authorize what Larry had articulated, so if it works with what I took the liberty of jotting something down. If you want to change it, feel free. The board authorizes a planned addition of 24 corporate authorized positions, 4 being increasing fire's pro rata share for the additional positions by $133,853, bringing fire's total corporate share to $370,491. We would need I can make that motion if you like. You need a second for that?
Second.
Are there any objections? Hearing none, the motion passes.
Thank you. That ends the agenda for the public session.
And then we need a motion to move out of the public session.
So moved.
Is there a second?
Second.
Any objections? Hearing none, the motion carries. We're out of public session. Would you, at this point, would you,